virtual annual meeting of Berkshire Hathaway. We did in Omaha last year on short notice. We had more warning this time, and so we came to Los Angeles, and the reason we're doing it from here is because of the man on my left. Not because he asked for it, but because all of us wanted to do it with Charlie in here in Los Angeles. So I'll introduce the three vice chairmen of Berkshire in a minute. I'll show you the first quarter earnings. We won't take much time on that. I'll have one or two very short lessons for perhaps the new investors who are not necessarily in Berkshire Hathaway, but people who have entered the stock market in the last year. And I think there have been a record number that have entered the stock market. I'll have a couple of little examples for them, and then we'll swing into a Q&A led by Becky Quick, who's looked at thousands of questions that have been submitted to her. But more can be submitted during this meeting, and we will put up on camera from time to time the way you can communicate directly with her if you want to send questions in during the meeting. She got flooded with them last time, and she miraculously keeps sorting them out. And so feel free to send in a question, and we will have a question period for about 3.5 hours. And then we will finally have the annual meeting, which won't take long, at the end. So with that, I would like to first introduce the three vice chairmen of Berkshire Hathaway. I'll tell you just a little bit about them, and then I'll have a mild surprise for you at the end, perhaps. On my left is Charlie Munger, and I met Charlie 62 years ago. He was practicing law in Los Angeles. He was building a house at that time a few miles from here, and 62 years later, he's still living in the same house. Now, that was kind of interesting because I was buying a house just a few months before, 62 years ago, and I'm still living in the same house. So you've got a couple of fairly peculiar guys, just to start with, in terms of their love affair with their homes. And Charlie and I hit it off immediately, and I would say he's probably the vice chairman in charge of culture, among other things. But if I ever want to get questions about where true north is, I talk to Charlie, and he has been an enormous help. He's done it with a lot fewer hours and a lot less talking and everything than I have, but he's contributed in an incredible way to Berkshire. So Charlie's been out here in Los Angeles for 60 plus years. On my right, your left, I have the vice chairman in charge of everything except insurance and investments, Greg Abel. Greg was born and raised in Edmonton, Alberta. He's Canadian, plays hockey. His 8-year-old plays hockey. And he came to the United States sometime after he graduated from college in Canada. And he is in charge of a business which has well over $150 billion in sales and employs more than 250,000, probably 275,000 people, and does a much better job at doing that than I was doing previously. And on my far left, you're right. We have Ajit Jain, and Ajit was born and raised in India, graduated from college there. And I met Ajit on a Saturday in 1986, and I'd been in the insurance business. Berkshire had been in the insurance business for quite a while, and I was kind of stumbling around in various ways. And Ajit came to the office, and Saturday I was opening the mail, and I said, how much do you know about insurance? And he said, nothing. And I said, well, nobody's perfect, and let's talk about it some. And by the end of the morning, I knew I had somebody that was going to build a great insurance business. And starting from that point, this improbable little company in Omaha became the largest property casualty company in the world in terms of net worth. It writes risks occasionally in a 24-hour period that other companies simply couldn't take on themselves. They'd have to assemble other people. It would take them a long time to come to a decision. That was very important at various times in the past. It's not so important now. But he's built an incredible, the world's leading property casualty insurance company. So here we have Charlie from L.A., 60-some years. We've got Greg from Canada. We've got Ajit from India. And the one thing in common that these three fellows have, aside from working for Berkshire and doing a sensational job, the one thing in common is that at one time or another, for some extended period, they lived within a mile of me in Omaha, Nebraska. And Charlie, in 1934, moved about 100 yards away from where I now live and went through high school and eventually went in the service and knows the neighborhood as well as I do. Went to the same grade school my kids went to and so on. Greg spent significant time in living in Omaha, lived about 5 or 6 blocks from me, now lives in Des Moines. And Ajit was in Omaha, about a mile away for a couple of years. So we started in very different places and sort of came together and now go our separate ways, but it's all worked very well. I urge you to send questions if you're thinking. You can direct them to me or you can direct them to any one of the other three, and it will be a big relief to me if you direct a fair number to the other people. So we, this morning, as we always do it on Saturday, we published our 10Q, which gave the quarterly earnings. It's up on our website, BerkshireHathaway.com. It's very interesting. We put these out on Saturday morning. That's not because the media likes us to do it that way. It's not because the analysts like to do it that way. But we want to give you the maximum time to digest an awful lot of information that's in that 10Q. It can't be summarized in a perfect way. We'll give you some summary figures. But if you're really a student of the place, and most of our investors buy because they simply have faith in these other three fellows to do a good job. And that's not a misplaced faith. But if you really enjoy going into the details and you want to understand the nuts and bolts of Berkshire Hathaway's various operations, you should read that 10Q. And it may take you a couple of hours. I mean, it's not a small investment of time, but it's got a lot of information about all our various businesses. And for those of you who are business students of a sort, I recommend you go to it. The summary figures you see here, which are the ones we put in our press release, show kind of an interesting pair of numbers. I mean, down there at the bottom, we have last year. When you see those brackets around numbers, you got to start worrying. And first quarter, we actually showed a loss of almost $50 billion. I never thought I'd ever see a figure like that. And I was thinking back. I was trying to remember whether I'd gone on vacation during that quarter and turned things over to the other guys or what. But I checked the calendar, and that was me. And that figure this year is a positive figure of $11.7 billion. And neither figure is very meaningful in itself. The Accounting Standards Board a few years ago, for many years, unrealized gains or losses of a company like Berkshire were made adjustments to the net worth of Berkshire, but they did not run through earnings. And a few years ago, the rule was changed so that every time the stocks go up or down, it goes through our earnings account. So in the first quarter of last year, when stocks went down a lot, we had a huge sum of unrealized. Well, it was a reduction of unrealized gains largely. And when you start saying things like that, you start losing people. But that item was the mild plus this year. But if we reported earnings daily, you would see earnings one day of $3 billion, next day of minus $2 billion, and it's it's an accounting treatment that we don't think is particularly appropriate, but it's required, and we explain very carefully, both in our press releases that we try to explain, and I try to write in my letter and explain why I don't think that's the way to look at Berkshire. We think over time that we will have investment gains for reasons I lay out in my letter. Over a period of time, the companies we own stock in retain earnings, and they use those reinvested earnings usually to our benefit, and that shows up in capital gains someday. But reported earnings for a company that has a lot of common stocks, marketable stocks like ours, you don't want to look at that final line, and you do want to look at the operating earnings line. Now, I would say that if you had taken the first 2 months of last year and compared to the first 2 months of this year, those figures would have been quite comparable. But of course, in March of 2020, the economy was shut down. In effect, I mean, it was a self-induced recession, and an abrupt one, very abrupt. And so the economy went off a cliff in March. It was resurrected in an extraordinarily effective way by Federal Reserve action and later on the fiscal front by Congress, and we'll get into that later. But the figure you see that the difference was March, basically, the two. And our businesses have done, we'll get into more specifics later, but our business has done really quite well. This has been a very, very, very unusual recession in that it's been localized as to industry to an extraordinary extent. And right now, business is really very good in a great many segments of the economy, which we'll talk about later. But there's still problems if you're in a few types of business that have really been decimated, such as international air travel or something of the sort. So with that, we'll go back to the figures later on, perhaps in some of the questions. I would like to just go over two items that I would like particularly new entrants to the stock market to ponder just a bit before they try and do 30 or 40 trades a day in order to profit from what looks like a very easy game. So on March 31st, I ran off a list of the 20 largest companies in the world by stock market value. Those names, a good many of which will be familiar to you, but they were led by Apple at slightly over $2 trillion. And it went down to the number 20th was worth 330 odd billion. But those are the 20 largest companies in the world by market value on March 31st. I was hoping I could get a little quiz machine so I could have everybody weigh in on this answer, and we could flash it up a little later, but proved technically impossible. But what I would like you to do is look at that list. Starts off with Apple. Saudi Aramco is a pretty kind of a specialized company. It's I don't know whether it's 95% owned by the government or what, but it's essentially a country that's for sale there in terms of that business. But the top of the top 6 companies, 5 of them are American. So when you hear people say that America hasn't, it's not working very well or something of the sort, in the whole world, of the 6 top companies in value, 5 of them are in the United States. And if you think about it, we talked a little about this last year, but in 1790, we had 0.5% of the world's population. And a little less, we had 4 million people, 3.9 million people. 600,000 of them were slaves. Ireland had more people than the United States had. Russia had 5 times as many people as the U.S. did. Ukraine had twice as many people as the United States. So here we were But what did we have? We had a map for the future, an aspirational map that somehow now only 200 and, well, after the Constitution, 232 years later, leaves us with 5 of the top 6 companies in the world. It's not an accident, and it's not because we were way smarter, way stronger, anything of the sort. We had good soil, had decent climate, but so some of those other countries I named, and the system has worked unbelievably well. Just imagine thinking of 5 of the top 6 companies in the world ending up with a country that started with 0.5% of the population just a few hundred years ago. But what I would like you to do is look at that list for a minute or two, if you want to, and then make an estimate, make your own guess. How many of those companies are going to be on the list 30 years from now? Here they are, these powerhouses. And how many would you guess are going to be on the list? Well, it's not going to be all 20. It may not even be all 20 today or tomorrow, because this was March 31st. But what would you guess? And think about that yourself. Would you put on 5, 8? Well, whatever it would be. Slide 2, which goes back a little more than 30 years, and look at the top 20 from 1989. And if you look at the top 20 from 1989, there's 2 things that should grab your interest. None of the 20 from 30 years ago are on the present list. None. 0. There were then 6 U.S. companies on the list, and their names are familiar to you. We have General Electric, we have Exxon, we have IBM Corp. I mean, they're still around. Merck is down there at number. None made it to the list 30 years later, 0. And I would guess that very few of you, when I asked you to play the quiz a few minutes ago, would have put down 0. And I don't think it will be 0. But it is a reminder of what extraordinary things can happen, things that seem obvious to you. Japan had this wonderful bull market for a very long time, so you had a number of Japanese companies on the list. Today, there are none. And the United States had the 6. Now we have 13. But they aren't the same 6. I would invite you to think about one other thing as you look at this list. 1989 was not the Dark Ages. I mean, we weren't just discovering capitalism or anything else. And people thought they knew a lot about the stock market, and the efficient market theory was in, and it was not a backward time. And if you look, the top company at that time had a market value of $104 billion. So the largest company in the world, Tidal, in just a shade over 30 years, has gone from $100 billion to $2 trillion. At the bottom, the number 20 has gone from $34 billion to something a little over 10 times that. That tells you something about what's happened with equality, which is a hot subject in this country. It tells you a little bit about inflation, but this was not a highly inflationary period as a whole. But it tells you that capitalism has worked incredibly well, especially for the capitalists. And it's a pretty astounding number. Do you think it could be repeated now that 30 years from now that you could take $2 trillion for Apple and multiply any company and come up with 30 times that for the leader? It seems impossible, and maybe it is impossible. But we were just as sure of ourselves as investors and Wall Street was in 1989 as we are today. But the world can change in very, very dramatic ways. And I'll just give you one other example you might ponder. This is when you start feeling too sure of yourself. One thing it shows, incidentally, is that it's a great argument for index funds. Is that the main thing to do was to be aboard the ship, a ship. They were all going to a better promised land. You just didn't know which one was the one they'd necessarily get on. But you couldn't help but do well if you just had a diversified group of equities. U.S. equities would be my preference, but to hold over a 30-year period. But if you thought you knew a lot about which ones to pick, or the person that you had hiring, you were paying a lot of money to, had all these ideas, they could tell you their best ideas in 1989 did not necessarily do that well, although overall equities were absolutely the place to be. Secondly, people get enormously attracted to various industries. I mean, they think if you know, if a company says it's in the XYZ industry and that's a popular one, you can sell IPOs, you can sell SPACs, people disregard sales numbers, earnings numbers. It's just, it's the place to be. So Berkshire Hathaway, where was the place to be in 1903 when my dad was born in 1903, but that wasn't really that big of news. But and it wasn't big news that actually Henry Ford was starting the Ford Motor Company. He'd failed a couple of times before, but he was about to change the world. I mean, the auto, when you think about everything, we've got a great auto insurance company. If there weren't any autos, we wouldn't have Geico. But it transformed the country. And Henry Ford brought in the $5 daily wage, and that was a huge thing. Assembly lines, everything, autos came along. So let's just assume that you had seen a quick glance back in 1903 of all the interstate highways, 290 million vehicles on the road in the United States. Everything about it. And you say, well, this is pretty easy. It's going to be cars. It's going to be autos. Berkshire, by accident, well, we own a company called Marmon. We bought it from the Pritzker family some years ago. The Pritzkers had built this business from many, many, many companies that they'd acquired. And the name of their company was Marmon. And I don't know exactly why Jay and Bob decided to name it Marmon, but they owned this company Marmon, which in 1911 had been the company whose car won the first Indianapolis 500. Maybe that's why they called it Marmon. They were proud of the fact that the company in 1911 won the first Indianapolis 500. It also was the company that invented the rearview mirror. I'm not sure whether that was a big contribution to society, and certainly around your household. Rearview mirror, you don't want to emphasize too much, but they the car that was entered in the Indianapolis 500, the guy who normally sat next to the driver and looked backwards to tell what the competitors were doing, he was sick, so they invented the rear view mirror. So let's just assume that you decided that autos were this incredible thing, and someday there'd be an Indianapolis 500, and someday they'd have rear view mirrors on cars, and someday 290 million cars would be buzzing around the United States, or autos, or the county trucks there. And so I decided to look at the history, and I thought I'd put up the list of auto companies from over the years. I was originally going to put up just the ones that were the M's so I could get them on one slide. But when I went to the M's, it went on and on and on. So I just decided to put up the ones that started with M-A. And as you can see, there were almost 40 companies that went into the auto business, just starting with M-A, including our Marmon there in the middle column, which lasted for a while, quite a while. It was selling cars in the 1930s were really quite special. But in any event, there were at least 2,000 companies that entered the auto business because it clearly had this incredible future. And of course, you remember that in 2009, there were 3 left, 2 of which went bankrupt. So there is a lot more to picking stocks than figuring out what's going to be a wonderful industry in the future. The Maytag company put out a car. Allstate put out a car. DuPont put out a car. I mean, there was a Nebraska Motor Company. Everybody started car companies, just like everybody's starting something now that can be where you can get money from people. But there were very, very, very few people that picked the winner or got the opportunity. At Ford Motor, Henry Ford had a few partners, and he really didn't like them, so he figured a way to buy them out. That was one. It was sort of the beginning of the auto finance. That's a long story. We won't get into that. But you couldn't buy into Ford Motor, and of course General Motors became the dominant company. Finally, when Henry Ford did not really make the shift from the Model T to the Model A, it did not work very well. So I just want to tell you, it's not as easy as it sounds. And with that, we will go to Becky Quick, and she will ask any of the four of us questions she has selected and which she doesn't share with us.
You're well known for saying to be fearful when others are greedy and be greedy when others are fearful. But by all appearances, Berkshire was fearful when others were most fearful in the early months of COVID. Dumping airline stocks at or near the low, not taking advantage of the fear gripping the market to buy shares of public companies at exceptional discounts, and being hesitant to buy back significant amounts of Berkshire stock at very attractive prices.
Until both monetary and fiscal policy kicked in, well, you knew we had an incredible problem. And I am, just as Charlie is the chief culture officer, I'm the chief risk officer of Berkshire. That's my job. We hope we do well, but we want to be sure we don't do terribly. But we didn't sell a substantial amount. I mean, we're a company with probably $700 billion worth of businesses. Some we own in their entirety, some we own a piece of. And I don't know whether we were sellers of maybe 1% of the value of all the businesses we had at that period. But the airline, it's kind of interesting with the airline businesses in particular, and then I'll get to what was done in fiscal and monetary policy. But we had a few people, various subsidiaries of Berkshire, that wanted to go in for help from the government, and in some cases they had minority shareholders owned a few percent, and they said, "Well, we're going to get killed by what's happening with the regulations that are being put out, and we're stopping the economy." And they said everybody's going in for them, and why don't we go in? I said, Berkshire can handle it. This is for people that can't handle what's happening, and so we're not applying. But the airlines were the most prominent beneficiaries of what took place immediately. They got $25 billion initially, most of which went to the big four airlines, and some of which went in as grants, not loans. I think that was fine public policy. I was wishing it could go to every restaurant and dry cleaner and every small business that really was out of business and had no. I mean, they were made toast of, basically. But the airlines, clearly, what happened was not their fault in any way, shape, or form. It wasn't like 2008 and 9 when people blamed the banks and hated to see them help. So it was. Now airlines operate in bankruptcy, so it isn't like that. Three of the four big ones went through bankruptcy within the previous 10 or 15. So the airlines that were kind of used to operating in bankruptcy, they would have kept operating, but it was perfectly proper for the airlines to be helped. The entire airline business, you look at these figures of $2 trillion for Apple and so on. The entire big four airlines, they sold for about $100 billion almost. I mean, it's a very, very small. Combined, they wouldn't come close to making the cut. I mean, they wouldn't be in the top 50. So anyway, they went into the government. They needed government help, or they would go bankrupt, some of them, and really the Congress, but Steve Mnuchin too. They decided they deserved the help, which I do not quarrel with at all. But imagine if Berkshire was the 10% holder, which they had been, of everyone in the airlines. They said, to get it from Berkshire. I mean, it'd be like one of our, they might have very well had a very, very, very different result if they'd had a very, very, very rich shareholder that owned 8 or 9%. And they didn't have that, when they went in. So you might not have gotten the same result In fact, I would think you probably wouldn't. I mean, I can just see the headlines now. I mean, because you've seen the headlines on some companies that took $100 million or two, and really didn't need it, and some of them gave it back, and most of them gave it back. But you're actually looking at probably at a different result than if we'd kept our stock. But in any event, an industry that was really selling for less than $100 billion lost significant amount of money. They lost prospective earning power. I mean, right now, international travel's not come back. But I would say overall, too, that the economic recovery has gone far better than you could say with any assurance. So we didn't like having as much money as we had in banks at that time. So I cut back some of the bank investment. But basically, our net sales were about 1% or 1.5%. And looking back, it would have been better to be buying. But I do not consider it. I do not consider it a great moment in Berkshire's history. But I also don't. We've got more net worth than any company in the United States under accounting principles, and we've got 600 or 700 billion of generally good businesses, and I think the airline business has done better because we've sold, and I wish them well. But I still wouldn't want to buy the airline business. International people really want to travel for personal reasons, and business travel is another thing. And we've got a big exposure to business travel, of course, through the fact that we own 19% of American Express, and we own Precision Castparts, which services the air business very dependent. So we've still got a big investment in air travel, a big commitment to it. But we wish the Big Four the best, and I think their managements have done a very good job during this period.
You spent years accumulating cash, insisting you had your elephant gun ready. The March 2020 listed equity sell-off came with promises from the U.S. government that they would do what it takes, yet you sat on your hands. Please help me understand what I missed.
We have our cash on hand has been about 15% of our values of our businesses, and that's a healthy chunk. And I'd say it'll never get below 20 billion, but we're going to raise that number because it's just the size and importance of Berkshire. But we could have deployed 50 or 75 billion, and right before the Fed acted. I mean, we hit a point where two calls came in, but there was 2 or 3 days. I mean, nothing could happen. I mean, when Jay Powell acted as he did, that was incredibly important. I mean, I shouldn't say the Fed acted as they did, but they moved with speed and a decisiveness on March 23rd that changed a situation where the economy had stopped. The government bond market was even disrupted. Berkshire Hathaway probably could not have gone out with a debt offering the day before. There was it didn't get a lot of publicity time, but there was a run on money market funds, a very substantial run. And if you look at the numbers, daily numbers on that, it was a repeat of September 2008. And this time, I give great credit to what Bernanke and Paulson did, but this time, the Fed knew that saying whatever it takes and saying it and demonstrating it, which they did on March 23rd, they took a market where Berkshire couldn't sell bonds on the day before and turned it into one where Carnival Cruise Lines or something could sell it a day or two later. And there was, it's record issuance of corporate debt, and companies losing money, companies who were closed, whatever. It was the most dramatic move that you can imagine. And at the time, as I remember the chairman saying, how about a little help on the fiscal front? And then Congress acted very, very big again. In 2008 and 2009, they argued about, we don't want to give any money to those dirty banks and all that sort of thing. But this time, there really wasn't anybody to blame. So they saw what was necessary, and Congress responded. So you had fiscal and monetary policy that responded in a way that was incredible, and it did the job. And I think it did a better job than either the Fed or the Treasury or anybody expected. I mean, this economy right now is 85% of it is running in super high gear, and people can't, and you're seeing some inflation and all of that. It's responded in an incredible way, and we learned something out of 2008 and 9, and then we applied it. But I don't think it was a sure thing that would happen. And the one thing about Berkshire is we don't want to depend on anybody. We're not a bank. We can't go to the Federal Reserve if we need money, and we've got to be sure that under any circumstances, we can't solve nuclear war, and maybe we can't, but. Blanche Dubois, if you remember, in the Streetcar Named Desire, said, "I depend on the kindness of strangers." You can't depend on the kindness of your friends if things really stop. I mean, I've seen that in several different places, and we were seeing it on the middle of March. Everybody was drawing down the credit lines. The banks did not expect that. They just weren't sure they were going to be able to draw down their credit lines 10 days later, and so they just drew them down, and they took the money out of money market funds. We got very prompt. I give great credit on both the monetary and fiscal side of what was done, but I didn't think it was a sure thing that would happen, and I didn't know how it would be implemented. And it's worked. I think it's worked better than just about anybody has expected. And I think, well, you're seeing it now. Charlie's got some views on this too, so we shouldn't leave him out of it.
Well, it's crazy to think anybody's going to be smart enough to husband money and then just come out on the bottom tick in some crazy crisis and spend it all. There always is some person that does that by accident. But that's too tough a standard. Anybody expects that of Berkshire Hathaway is out of his mind.
Yeah, Charlie and I never were very good at dancing, but we really can't do that dance.
No, we can't. And that, by the way, almost nobody else can either.
Not with tens of billions or hundreds of billions. But it's worked out. Well, we forgot to show one of the financial sides, actually, if you go back to the balance sheet. But we did buy in the first. You'll see the shares outstanding if we go back to what is it, E3?
E2. You look.
Slide.
E2. Yeah.
Pardon me?
I think it's E2. Is that?
Well, the balance sheet, yeah, there it shows the shares outstanding at the bottom, and we spent about $25 billion in the first quarter and more money since, and it's the best thing. We can't buy companies as cheap as we can buy our own, and we can't buy stocks as cheap as we can buy our own. So, and we've been able to do that with a fair amount of money. But looking back, I mean, if you, definitely we could have done better things. We would have sold airlines and cut back on banks regardless. Whether we should have bought something else at the same time is another question.
After a 15-year period of market underperformance, you're cautious about predicting Berkshire being able to outperform the market in the future. Given this, what do you see as the arguments for longtime shareholders to continue holding their stock versus diversifying their risk across an index?
Charlie, you want to answer that?
Well, sure. Well, I personally prefer holding Berkshire to holding the market. So I'm quite comfortable holding Berkshire. I think our businesses are better than the average in the market.
Is it because you don't think the market values it fairly?
Well, these are just accidents of history, and things are fluctuating at all times. But on a composite basis, I'd bet on Berkshire over the market. That's assuming we're all dead.
I recommend the S&P 500 index fund, and have for a long, long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And I've made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund and 10% of Treasury bills. And on the other hand, I'm very happy having my future contributions to a group of charities that will be spread over 12 years or so after my death to stay in Berkshire. I think the odds are Berkshire is, I like it, but I'm not. I do not think the average person can pick stocks. We happen to have a large group of people that didn't pick stocks, but they picked Charlie and me to manage money for them 50 or 60 years ago, and so we have a very unusual group of shareholders, I think, who look at Berkshire as a lifetime savings vehicle, and one they don't have to think about, and one that they'll look, if they don't look at it again for 10 or 20 years, that will have taken care of the money reasonably well. But that, I wouldn't argue that the S&P 500 over time. I like Berkshire, but I think that a person who doesn't know anything about stocks at all and doesn't have any special feelings about Berkshire, I think they ought to buy the S&P 500 index.
I believe you've directed the trustees of your estate to invest substantial assets into the index fund. Isn't that a vote of no confidence to your managers?
Well, no, because we're talking about way less than 1% of my estate. And one thing I'm going to do, incidentally, all rich people get advised by their lawyers, set up trusts so that nobody can see your will and all that sort of thing. My will is going to be public record, and you'll be able to check at some point when I'm telling you the truth about what is going to get done. But 99.7% roughly of my estate will either go to philanthropies or to the federal government, and before it does it, I think Berkshire is a very good thing to hold. But for a given individual, particularly my wife, I just think that having a tiny fraction, which is all it takes for her to do very well for the rest of her life, I think that the best thing to do is buy 90% in an S&P 500 index fund. Now, the index fund people naturally have started over the time. They market more and more products that go to other indices and everything. So they're really starting to say to the American public, they're saying, well, you can pick what continent to invest in, or you can pick what industry, and we'll sell you something for that. And when they just have gotten through telling them, you really don't know anything about stocks, and just buy the whole index. So, so I named the 500 index as one, but it's a tiny portion, but it'll be her livelihood, and she'll have all the money she needs and way beyond it, and that's that. But I don't mind having the 99.7%, large portion of it, assuming that the law is the same as now, go to philanthropy, to be kept in Berkshire until they finally are disposed of.
Can investors still assume an oil and gas business that finds and produces oil at low cost per barrel can generate a sufficient return on capital for a long time to come?
Well, I'll give you a 10-word answer to that. I can't remember all the questions that were there, but I would say that people that are on the extremes of both sides are a little nuts. I would hate to have all hydrocarbons banned in 3 years, or you wouldn't want a world, it wouldn't work. And on the other hand, what's happening will be adapted to over time, just as we've adapted to all kinds of things. I do not think, I'm interested in that quote from 1997, because we've talked about this before. We have no problem owning Costco or Walmart, and a substantial number of their stores, and they sell cigarettes. It's a big item. It's something that brings people in. They know the price of cigarettes, and they put them up front, and so we don't. It's a very tough situation. We made that decision a long time ago when we went to Memphis, and we looked at a business that was a very, very good business, and it was much less harmful at least from everything I could find out. It was much less harmful than smoking tobacco, chewing tobacco was. And these were decent people, and they were running a legal business, and they all chewed tobacco themselves. So they told me that their mother was 100 and chewing tobacco and all these things. But Charlie and I did go down in the lobby of that hotel, and we just said to ourselves, this is probably the best business we've ever seen. And I called my then son-in-law, Alan Greenberg, and he'd studied chewing tobacco and its effects when he was working for a native-related organization, and we decided not to do it. But, would we, I used to see ads in our paper from financial companies where I knew they were terrible, and it's a very tough thing to decide whether you get in or out of a business. And it's a very tough time to decide what companies benefit society more than others. I mean, I don't know whether, I think Chevron's benefited society in all kinds of ways, and I think it continues to do so, and I think we're going to need a lot of hydrocarbons for a long time, and we'll be very glad we've got them. But I do think that the world's moving away from them, too, and that could change. I don't like making the moral judgments on stocks in terms of actually running the businesses. But there's something about every business that if you knew what you wouldn't like. Meat packers or anything. Have you ever gone through a meat packing? If you expect perfection, in your spouse or in your friends or in companies, you're not going to find it. And what you elect to do yourself, if you own an index fund, you're going to own Chevron. And believe me, Chevron is not an evil company in the least. and I have no compunction about owning, in the least, about owning Chevron. And if we owned the entire business, I would not feel uncomfortable about being in that business. Charlie?
Well, I agree. You can imagine two things. A young man marries into your family. He's a English professor at, say, Swarthmore, or he works for Chevron. Which would you pick? Because I don't see. I want to admit I'd take the guy from Chevron.
Well, I hope your daughters agree with you.
The board recommended voting against on the shareholder proposal regarding the reporting of climate-related risks and opportunities. Please share with us more about the against recommendation.
Well, I think maybe Greg can talk a little bit about what Berkshire has done as opposed to in terms of the environmental. I would say this: it's very interesting. With everything that's being, I think we have over 1 million shareholders. I mean, you can't be 100% sure because of street name and duplicate accounts and all that sort of thing, but it certainly seems very, very likely. I've had, and I get the letters that are written to me. I don't think I've had 3 letters in the last year or anything from shareholders. Now I have them, and our vote on this, as you'll see later, is that overwhelmingly the people that bought Berkshire with their own money voted against those propositions. Most of the votes for it came from people who've never put a dime of their own money into Berkshire, and so they. And I don't think they've read our annual reports, and I don't think they've read the reports of Berkshire Hathaway Energy, and I don't think they know. If I talk about what we're doing in high voltage transmission, we're doing more than any company in the country. The president talked about what the government's going to do and how important it is, and we have a record that's overall is incredibly good, but we have a group of organizations just generally, and they're nice people, but they want us to answer a bunch of questionnaires their way, so they want us to go to Dairy Queen and Borsheim's and all those people, have them fill out reports that show a bunch of figures when the reports that count are the reports that Greg gets on Berkshire Hathaway Energy and the railroad. And you talk about 3 of our companies and you've covered 95% of it. it's asinine, frankly, in my view. Now, we do some other asinine things because we're required to do them, so we'll do whatever's required. But to have the people at, Business Wire, Dairy Queen, all these places, filling out reports to make it some common report that comes in. We don't do that stuff at Berkshire. We've got, during the pandemic, we probably have about 12 people that come into headquarters, and we've got 360,000 people working in a company that all kinds of diverse activities, and it's built. I don't want to get into the whole thing. It's built on autonomy, and I am probably the only CEO of an S&P 500 company that does not get a consolidated income statement every month. I mean, every other company, I'll bet in the S&P 500, prints out the earnings they had at the end, from February and March, and the CEO gets, and a whole bunch of other people get it. I don't get it. I don't need it. And I could put 60 or 70 companies in a whole lot of trouble and everything, and they'd hand me something and I know the answer to it already, and it doesn't make any difference. I mean, they've got the money they need. So we don't do things just because we've got a department of this or a department of that, and we don't want to set up a lot of departments like that. And what's important is what we're doing in primarily at Berkshire Hathaway Energy and the railroad. I mean, that's and I'll let Greg tell you about that in just one second. But
Warren, I don't think we know the answer to all these questions about global warming and so forth. And the people who ask the questions think they know the answers. We're just more modest.
Well, but even if we knew the answer, I mean, in terms of the reports we would we would not collect a whole lot of things that don't mean anything to us, and to satisfy people who actually don't own any stock themselves, and in many cases I can tell they haven't read our annual report even. We, as I pointed out in the annual report, and nobody would have guessed this. People think we're a bunch of guys that own stocks and all that sort of thing. Berkshire Hathaway owns, by GAAP accounting, more property, plant, equipment, business infrastructure, which the president just got through talking about Wednesday night in infrastructure, the importance of it. We have, measured by GAAP accounting, more than any other company in the United States. We have more than any of those companies that are on the list of the largest companies in the country, but we've got it by a substantial margin. So we have an investment in what makes this country move and work. 15% of the interstate goods move on our railroad. And we're building transmission, and we started in 2006 or 7 planning how we would close coal plants. But you can't close coal plants until you get the electricity from where it's generated to the customer. And if you're going to generate it in Wyoming, and it's going to go to Las Vegas or someplace, and previously they had a coal plant near the place because that was the way it was done 50 years ago or 75 years ago. You better have the transmission. There's no sense having the wind blow in Wyoming and people turn on the lights in Las Vegas. So we went at the transmission plan question a lot earlier than people were talking about it. And we said 16 billion or whatever it was in the annual report that we underway, and we just added 2 billion since the annual report came out. And there's no utility in the country that's coming anywhere close to that.
BHE and BNSF have the significant carbon footprints when you think of Berkshire. And Warren, you touched on the disclosure that we've provided in the past, going all the way back to 2007. I did pull those two investor presentations, one from 2007 and then our most recent one in 2021. So as a slide, I think it would just highlight, going all the way back to 2007, we've been doing investor presentations for our what we call our fixed income investors. And we've done that through every year through 2021. We've provided very similar disclosures to our board on an annual basis and had discussions around Berkshire Hathaway's energy plans to decarbonize. Now, it's interesting, if you go back to the 2007 fixed income conference, and we were having a conference at that point in time, we have third-party debt, capital debt that our utilities raise. It's a traditional capital structure used across our regulated entities to manage our total cost to the customer. So we have investors. We present to them as we're highlighting on an annual basis. And if you go back to that 2007 investor conference, it's interesting. In that presentation, we're highlighting climate change, that it's a fundamental risk, and we discussed what good policy would be. We discussed innovation, we discussed market transformation, and the importance of setting targets at that point in time, and we had recommendations for our industry. And then since then, each year we've presented really a plan and a strategy around how each of our businesses in BHE, but each of our regulated entities, how they're going to transform. And the whole transformation has been around decarbonization, managing that risk on behalf of our stakeholders in our many states, our customers that we serve, and ultimately managing that risk for Berkshire Hathaway's shareholders. Now, as you go through those presentations, there's a common theme, and Warren touched on it already. You have to build the foundation first. And that foundation is around building the high voltage, the transmission system. Warren touched on it in his annual report this year, and letter he highlighted that at Berkshire Hathaway Energy we'll be spending just in the West $18 billion on transmission. $5 billion of that's already been spent as we sit here today, and that $13 billion will be spent over the next 10 years. That's the foundation that then allows us to build incremental renewable resources and move it to our many states that we serve at Berkshire Hathaway Energy and well beyond that. I would highlight, while we've been building the transmission infrastructure in place, we have been building renewables. If you look at our investment through the end of 2020, we've invested $30 billion, or in excess of $30 billion, into renewables, and have really completely changed the way our businesses do business, i.e. our utility businesses. They've been decarbonizing and delivering a valued product to our stakeholders, to our customers. And I think the results are really amazing when you look at them, and I'll give you a couple of reference points. If you go back to 2015, when the U.S. was discussing, joining the Paris Agreement, very specific targets were set. Prior to those targets being set, Berkshire Hathaway Energy and 12 other companies, including the Apples of the world, Google, Walmart, committed to Paris, and that targets needed to be set. Berkshire Hathaway Energy was one of those companies in 2015.
Yeah, how many other utilities were there?
Right, Warren, there were no other energy companies that made any type of commitment at that point in time. I'm happy to report we made a variety of pledges. Well, one of them was, at that point, we'd invested $15 billion in renewables, and that we would commit $30 billion in total. Well, we far exceeded that total now. So there's been a clear commitment to decarbonizing our businesses. We have focused on very identifiable, quantifiable outcomes, and I think that's very important. If you look at the standards that were set with the original U.S. government's commitments associated with the Paris Agreement, the target was 26 to 28% reductions in carbon footprints going back to 2005, so that's the reduction period, through 2025, and they wanted the 26 to 28% reduction level. We committed to that at BHE, and I'm happy to report, Warren, we've briefed our board, we achieved that in 2020. So we met our pledge, and we met the commitment under the Paris Agreement. And then if you fast forward to the discussions that are occurring right now, or have occurred, around rejoining the Paris Agreement, the current administration has proposed that again, using 2005 as a starting point, that the emission goals or reduction should be 50 to 52% by 2030. Again, I'm happy to brief to our shareholders and briefings we've provided to our board, but Berkshire Hathaway Energy will achieve that by 2030. Our reductions will hit the Paris Agreement target. Again, the reason we can do it is we've built the foundation through transmission, the substantial investment that Warren's highlighted, and then followed that up with very specific investments on the renewable side. I have one incremental slide that I hope sort of pulls it all together. As people discuss carbon, they often go to coal units, how many you own, how many of you close. And there's no question that can be an important metric, but it is a transition. And we have very much focused across the three utilities we own and the ones we've highlighted on the slide is to transition from our existing fleet to renewables using transmission. We have not become overly dependent on transitioning to gas. That's been a clear strategy. So over a period of time, our coal units will retire. I'm happy to report, or pleased to report, to our shareholders that through 2020, we've closed 16 units to date. If you look at from 2021 through 2030, there'll be an incremental 16 units closed. And then if you go through to the end of 2049, our remaining 14 units will be closed. And at that point in time, all our coal units are closed. That slide is just an aggregation of all the activities each of our business units have been taking to help facilitate that transition and really transitioning to a decarbonizing those units. And I said decarbonizing our businesses on behalf of, first and foremost, our customers, the many stakeholders they represent in the various states. And then equally important, decarbonizing those businesses on behalf of our Berkshire Hathaway shareholders. The only other thing I would add, because it is the entity that has the second largest carbon footprint in Berkshire, and when you combine BNSF and BHE, you're talking the material set of emissions within Berkshire. BNSF has also been very active in managing their carbon profile. They've committed to have science-based targets established for 2030. So again, those targets will again be consistent with the Paris Agreement. We've seen what the other participants, or some of them in the class in the industry, that have committed to. And our commitment will be very similar. It'll be consistent with the Paris Agreement, but it'll be a 30% reduction in BNSF's footprint by 2030. So again, if you look at our, and that's been publicly disclosed, that's on the BNSF website. Everything I've discussed regarding BHE is on their website, filed in 8Ks, completely accessible by our many shareholders. So when I look at it from the perspective of our Berkshire shareholders, I really believe this risk is being well managed, and we're positioning ourselves for the long term. Thanks, Warren.
Yeah, incidentally, I mean, the president the other night talked about $100 billion for infrastructure. We'd love to spend $100 billion, but he was talking about, transmission is really the problem. I mean, a big problem, because you got to get from where the sun is shining and where the wind is blowing, essentially to concentrations of population, and it'll be whether you cross state lines and you go through people's backyards. It's whether the federal government has a better luck in just saying this is the way it's going to be done and ramming it down the throats of where they go and getting it done. I mean, they may have that power, and they'll be able to do it faster than we are. On the other hand, we'd love to do it. We'll spend the $100 billion, but the speed at which we can do it we bought Pacific Corp in 2006, and we had a bunch of customers out in the far west, and they had coal plants serving them. And to change that, you've got to be able to go to where wind blows and deliver it. So but it is interesting that we have published this information. We've spent far more than any utility than in terms of renewables and transmission in the United States. And we started with a nothing, little operation. But the people who bought the stock with their own money, the individuals, they seem to understand it, and they read the reports. And we get calls, and they say, well, we want to come out and talk to you about it. Well, we're not talking to them and ignoring the million people that have been with us over time and bought it with their own money. We will not give special treatment to either to analysts or to institutions over the individuals that basically trust us with their savings for their lifetime.
My biggest concern is around possible losses arising from higher than expected insurance losses. We've seen this in other great companies where underwriting mistakes end up crippling businesses previously considered exemplar. While I understand that Berkshire's culture is unique and the insurance division is full of talented individuals, this is a risk that concerns me. Many of us shareholders feel comfortable now, given the privilege of having Mr. Buffett, Mr. Munger, and Mr. Jain looking at these deals. However, there will be a day when this is no longer the case. Is it reasonable to think that over the long term, Berkshire should focus on plain vanilla short-tail insurance businesses like Geico and reduce the size of some long-tail risk? I want to clarify that I have the most respect and gratitude for all of Berkshire employees that have built the best insurance group in the world. I'm confident we have this talent to remain leaders in this field for decades to come. This is focused on the inherent opaqueness and risk of some insurance lines.
I mean, clearly contract certainty is an issue for us in the insurance industry. It is an issue that cuts across not only the long-tail lines that you mentioned, but even short-tail property-focused lines. The most recent example is business interruption, which is an integral part of any property insurance policy that is bought and sold by corporations. It is a risk every time we issue a contract that either because of sloppiness in terms of how that contract is written or because of the regulatory environment we all have to live in, that the words in the contract may be tortured and normally when they are tortured, they end up going against the insurance industry, not in their favor. So it is a risk. It's an unknown risk in terms of how bad it can be. I hope we price for it. When we price for the product, we throw in something for the unknown unknowns, if you will. And we try and aggregate our exposures by major risk categories. Hopefully that will give us some comfort in terms of having some boundaries on what the exposure really can be. But there's no question the regulators play a very important role in terms of the economics of the business, especially in the US where there are 50 state regulators who we have to deal with in terms of pricing, in terms of contracts, in terms of...
Most of the surprises in insurance, practically all of them, are unpleasant. I mean, you get the premium up front, that's pleasant. And then from there on, you get some very imaginative losses that come through, and you get some that you've taken on. We are willing to lose in terms of sort of the outside limit. We think, well, we're willing to lose $10 billion in a single event. And we want to get paid very appropriately for that. But we've got the resources to do it, and but we don't want to lose $10 billion in something where we only thought we could lose $50 million or something like that. And the current situation, for example, with the Boy Scouts of America, I think there were 1,100 claims or something like that have been filed, and now there's 17,000 just in.
No, they're close to 100,000 now.
Oh, yeah, and
up by 50 times.
And these go back to 1950 or 1960, and you've got people advertising for claims, and so all of a sudden you get a lot of claims. I'm sure a lot of the claims are valid. I'm sure a lot of them are invalid. And how in the world do you pick out the difference?
Yeah, and it goes back to the issue that you just raised. The reason why this number of claims have skyrocketed from less than 2,000 to close to 100,000 is because the statute of limitations had expired. But in several states, if not in most states, they have unilaterally extended the deadline by when you can make claims and expanded it by a few years, as a result of which a lot of more claims have appeared, funded by plaintiff lawyers who are now very well funded, and that results in claims just skyrocketing.
Yeah, we get a lot of unpleasant surprises in insurance, but we've got a very. I'm very biased on this, but I think we've got the best insurance operation in the world, and Ajit is the guy that created it, and the people at Geico, we bought that, and we did wonderful things over time to contribute their part of it too, and other people have, but Ajit is a symphony conductor of it.
It looks like Charlie and Warren have some different opinions recently, like Costco and Wells Fargo. Where's that taking Berkshire?
Charlie?
Well, we're not all that different. And Costco is a company I very much admire, and I've enjoyed my long association with that company. But I love Berkshire too. So, and luckily there's no conflict. And Warren and I don't have to agree on every damn little thing we do. We've gotten along pretty well.
We got better than pretty. We have never had an argument.
Yeah.
In 62 years, and it's not that we agree on everything. We've literally, in 62 years, we've never gotten mad at each other. It just doesn't happen.
As you two are clear leaders of the next generation at Berkshire Hathaway, can you please tell us about how you interact with each other, or some of the other incredibly competent Berkshire managers you seek for advice?
There's no question that the relationship Warren has with Charlie is unique, and it's not going to be duplicated, certainly not by me and Greg. No, I can't think of very many other pairs that can duplicate it. Nevertheless, both Greg and I, at least certainly from my perspective, and I'm sure Greg will speak for himself, we've known each other for a very long time. I certainly have a lot of respect, both at a professional level and a personal level, in terms of what Greg's abilities are. We do not interact with each other as often as Warren and Charlie do, but every quarter we will talk to each other about our respective businesses and update each other on our respective businesses. And then during the course of the quarter, while we may not have any formal sort of meetings, if you will, but every time a question comes up which is related to insurance, Greg will pick up the phone and call me. By the same token, if there's any question that comes up relating to any of the non-insurance operations that Greg is in charge of, like we had recently where a client of mine was trying to find a buyer, and I picked up the phone and talked to Greg, and we talked about, how best to proceed. So there's that happens during the course of the quarter. Every quarter we exchange notes, and we have a perfectly well-functioning relationship between the two of us, and I hope it remains that way. Greg?
Yes. Well, as you well said, and as he touched on, Warren and Charlie have an exceptional relationship, but I'm very proud of the relationship Ajit and I've had. And as Ajit touched on, it's developed over many years. We've had the opportunity, or I've had the opportunity to see how Ajit's run the insurance business. And as Warren and Charlie highlights, there's no one better at it. So I've had the opportunity to observe that. And then equally over the years, that relationship has just built and become greater and greater. And as Ajit touched on, couldn't have more personal respect for Ajit, both personally and professionally. And even though the interaction may be different than, say, how Warren and Charlie do it, as Ajit touched on, there is a regular dialogue, both around opportunities within our two businesses and units, both if we see something unusual that the other individuals should hear, we make sure we're always following up with each other. But it goes beyond that. Ajit has a great understanding of the Berkshire culture. I strongly believe I do too. And anytime we see anything unusual in one of our businesses, it's Ajit who I'm going to call and say, are you comfortable that we're taking this approach? Is it going to be consistent with how you think about it, how you think about it in insurance? So it goes beyond just discussing the businesses, but that maintaining the exceptional culture we have at Berkshire and building upon that. So very fortunate to have Ajit as a colleague and immensely enjoy working with him every day.
It's on the profitability of Geico and BNSF. He said, why do these companies operate at meaningfully lower profit margins than their main competitors, Progressive and Union Pacific? Can we expect current managements to at least achieve parity?
Actually, if you look at the first quarter figures, you'll see that the Berkshire Hathaway Union Pacific comparison has got quite better. Katie Farmer's doing an incredible job at BNSF, and been an interesting question whether 5 years from now or 10 years from now BNSF or Union Pacific has the higher earnings. We've had higher earnings in the past. Union Pacific passed the first quarter. You can look at and they think they've got a slightly better franchise. We think we've got a slightly better franchise. We know we're larger than the Union Pacific. I mean, we will do more business than they do, and we should make a little more money than they do, but we haven't in the last few years. But it's quite a railroad. I feel very good about that. I should go back to the previous question. People talk about the aging management at Berkshire, and I always assume they're talking about Charlie when they say that. But I would like to point out that in 3 more years, Charlie will be aging at 1% a year, and no one is aging less than Charlie. If you could take some of these new companies with 25-year-olds, they're aging at 4% a year. So we will have the slowest aging managed percentage-wise by far that any corporate, any American company has.
Did you want to talk about Geico versus Progressive too? Because I got a lot of questions on that.
Progressive has had the best operation in recent years in terms of matching rate to risk, and I mean that's what insurance is all about, among other things. But I mean, you have to have the right rate. If you think that 90-year-olds and 20-year-olds have an equal chance of dying, I mean, you're going to be out of business very quickly in the life insurance business, and you will get all the 90-year-old risks, and the other guy will get the 20-year-old risks. And the same thing applies in auto insurance. I mean, there is a huge difference between 16-year-old males and how they drive, and 40-year-old married, employed people. So the companies that do the best job of actually having the appropriate rate for every one of their policyholders is going to do very well. And Progressive has done a very good job on that. And we're doing a much better job on that already. But Todd Combs has gone there, and it's a very interesting business. Both Progressive and Geico were started in the 30s. I believe I'm right about Progressive on that, and we were started in 36. We have had the better product for a long, long time, I mean, in terms of cost. And here we are, 85 years later in our case, and we have about 13% or so of the market, whatever it may be, and Progressive has just a slight bit less. So the two of us have 25% of the market, roughly, in this huge market after 80-some years of having a better product. So it's a very slow-changing competitive situation, but Progressive has done a very, very good job recently. We've done a very, very good job over the years, and we're doing a good job now, but we have made some very significant improvements. And if you looked at don't want to look at the quarters too much, but our profitability in the first quarter was good. But we gave back more money under our give-back arrangement when the virus broke out. We gave $2.8 billion on our give-back program that was larger than any company as well. It was the largest, I think, in the country. And Geico and Progressive are both going to do very well in the future. And actually, the Union Pacific and BNSF are going to do well in the future. It's just, in both cases, we want to do a little bit better than the other guy.
there's no question Progressive is a machine. They're very good at what they do, whether it's underwriting, which Warren talked about in terms of matching rate to risk, whether it's handling claims. Having said that, I think GEICO is catching up with Progressive. More than a year ago, about a year ago, Progressive had margins that were almost twice as much as GEICO's and growth rates that were almost twice as much as GEICO's. If you look at the results as of now, Progressive is still crushing it in terms of growth relative to GEICO. But GEICO has certainly caught up with Progressive in terms of margins, and hopefully that gap will be non-existent in the future. The second point I want to make on the issue of matching rate to risk, GEICO had clearly missed the bus and were late in terms of appreciating the value of telematics. They have woken up to the fact that telematics plays a big role in matching rate to risk. They have a number of initiatives, and hopefully they will see the light of day before not too long, and that will allow them to catch up with their competitors in terms of the issue of matching rate to risk.
I will predict that 5 years from now, State Farm is still the largest auto insurer, but I will predict that 5 years from now, it's very likely that the top two will be GEICO and Progressive, and in which order we'll see. But both companies are going to do very well, in my opinion. GEICO's done well, extremely well, but Progressive was better at setting the right rate, and we're catching up, I think, fairly fast.
Yeah, Progressive has certainly done better, but when it comes to branding, GEICO is, I think, miles ahead of Progressive, and in terms of managing expenses as well, I think GEICO does a much better job than anyone else in the industry.
Why didn't Berkshire buy more of Apple stocks in 2020? This seems to be counterintuitive.
Well, we have 5.3% or something like that now. It's gone up in the first quarter because we bought in our shares, which helps our own shareholders expand their interest in Apple indirectly without laying out a penny. And then Apple's repurchased its shares and just announced another repurchase program. So let's say we look at Apple as a business that we own at 5.3%. Now, we've got, it's a marketable security, so it shows up as way greater than any other marketable security we have. But of course, if you look at our railroad, as we mentioned, well, Union Pacific is selling for about $150 billion in the market, and we own one that's a little larger than the Union Pacific and making a little less money, but not much less. So it's an extraordinarily Apple. It's got a fantastic manager. Tim Cook was underappreciated for a while. He's one of the best managers in the world, and I've seen a lot of managers. And he's got a product that people absolutely love, and there's an installed base of people, and they get satisfaction rates of 99%. And I get the figures from the Furniture Mart as to what's being sold, and if people come in and they want an Android phone, they want an Android phone. If they want Apple, they want an Apple phone. You can't sell them the other one. I mean, the brand and the product is it's an incredible product. It's a huge bargain to people. I mean, the part it plays in their lives is huge. I use it as a phone, but I'm probably the only guy in the country. You know, maybe some descendant of Alexander Graham Bell's doing the same thing, but it is indispensable to people. And, you know, it costs, you know, car costs $35,000. And I'm sure with some people, if you asked them whether they wanted to had to give up their Apple or give up their car, you know, and really make the choice for the next 5 years, you know, who knows what they do. But and we you know, we got a chance to buy it, and I sold some stock last year, although our shareholders still had their percentage interest go up because we repurchased shares. But that was probably a mistake. In fact, Charlie, in his usual low-key way, let me know that you thought it was a mistake too, didn't you, Charlie?
Yes.
Yeah, I could only do so many things that I could get away with Charlie, and I kind of used them up between Costco and Apple. And incidentally, he probably, he very likely was right in both circumstances. It's an extraordinary business, but I do want to emphasize that in his own way, it's a different way, but Tim Cook is, we see a lot of managers of a lot of businesses, and you're looking at two great ones on both ends here. He's handled that business so well. He couldn't do what Steve Jobs obviously could do in terms of creation, but but Steve Jobs couldn't really, I don't think, do what Tim Cook has done in many respects.
Well, I also think it's clear that that list you showed of the leading American companies, it's been very important for America that we've done so well in this new tech field. And I personally would not like to see our present giants brought down to some low level by some anti-competitive reasonings. I don't think they're doing a lot of harm anti-competitively. I think they're a credit to the Americans, credit to our civilization.
And they're huge.
And they're huge, and that's good for us.
What's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks, gaining 50%, 100%, 200%, et cetera, in a matter of a year or less? How do you assess if these high flyers are worthy of your investment, given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy. But we don't, at least Charlie, I feel that I understand Apple and its future with consumers around the world better than I understand some of the others. But I don't regard prices, and that gets back. It gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter, essentially. And on the way out here, I tore out a little clipping from the Wall Street Journal yesterday. Probably the only one that read it. It's so small, I'm having trouble finding it. But anyway, yes, on Thursday, the U.S. Treasury sold some 4-week notes, Treasury bills, and the price was if you looked at your Wall Street Journal down a little corner next to the last page in my paper, in the very bottom corner, here it is. The results of the Treasury auction, little tiny thing. They sold they had applications on the 4-week Treasury bill for 100 and some billion. They accepted bids for 43 billion worth. And it says average price 100.0000000, 6 zeros. And essentially, people were giving 40-some billion dollars to the Treasury, and they offered to give 130 billion or something, whatever the amount tendered. And the Treasury received the money at zero. And Janet Yellen has talked a couple of times about the reduced carrying cost of the debt. I think in the last fiscal quarter, the U.S. Treasury, the U.S. government, which owes a few trillion dollars, I should say, a few trillion dollars more than a year ago, their interest expense was down 8%. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity pull by about 80%. I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much different. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough. Right now, nothing. It's very interesting. I brought this book along because for 25 or more years, Paul Samuelson's book was the definitive book on economics. It was taught in every school, and Paul was the first Nobel Prize winner. It's sort of a cousin to the Nobel Prize. They started giving it in economics, I think in the late 60s. He was the first winner from the United States, Paul Samuelson. Amazingly enough, the second winner was Ken Arrow, and both of them are the uncles of Larry Summers. Larry Summers had the first two winners as uncles. But Paul, he was a wonderful guy. He was a wonderful writer, the definitive writer. And so I got out the 73 economics books. And bear in mind, probably economics kind of started as kind of an interesting science and respectable. With Adam Smith, we'll say, he wrote The Wealth of Nations in 1776, and he'd written some books earlier, but you sort of date it from kind of when our country started. And then you had all these famous economists subsequently. And Paul became the most famous of his time. So I looked up in the back under interest rates. I looked for negative interest rates. There's nothing there. So I finally found zero interest rates, and Paul Samuelson, brilliant man, after a couple of hundred years we've had of kind of studying economics, basically, he said that you can conceivably, technically, you can conceive perhaps of negative interest rates, but it can't ever really happen. And that was, in the 1970s. This wasn't back in the dark ages, and this was and no economist wrote up and said, this is a terrible line to have in a book or anything. And here we are in this world where we had zero interest rates last week this week on a four-week note, and Berkshire Hathaway, which has more than this, but let's say we had $100 billion in Treasury bills. We have more than that. Before the pandemic, we were getting about $1.5 billion from that a year. At present rates, if it's 2 basis points, we'd get 20 million. Imagine your wages going from $15 an hour to 20 cents an hour. So it's been a sea change, and it was designed to be that. I mean, it was that's why the Fed moved the way they did. They wanted to give a massive push, just like Mario Draghi did in Europe in whenever it was 2012, when he says whatever it takes, and they went to negative rates. And the Fed has said it doesn't want to go to negative rates, and I think the Treasury actually has got some small bar on it. But if present rates were destined to be appropriate, if the 10-year should really be at the price it is, those companies that the fellow mentioned in his question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. But there's a view of what interest rates will be based in the yield curve out to 30 years and so on. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And we're sending out huge sums. I mean, the President said it on Wednesday, 85% of the people, we're going to get a $1,400 check, or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums. And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better. And people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics. But that is why the Googles and the Apples, when we don't own Google, we don't own Microsoft, but they are incredible companies in terms of what they earn on capital. They don't require a lot of capital, and they gush out more money. And if you're trying to find bonds that gush out more money from the federal government, we got $100 billion that's gushing out, like, you know, $30 or $40 million a year, or whatever it may be, depending on the short-term rates. So that puts the pressure on, which is exactly, of course, what the monetary authorities want done. I mean, they're pushing the economy and they're doing it in Europe, you know, even more extreme. And they're pushing, and we're aiding it with fiscal policy, and people feel good, and people have become numb to numbers. You know, trillions don't mean anything to anybody. You know, and $1,400 does mean something to them. So we'll see where it all leads. But Charlie and I consider it the most interesting movie by far we've ever seen in terms of economics, don't we, Charlie?
Yes, and the professional economists, of course, have been very surprised by what's happened. It reminds me of what Churchill said about Clement Attlee. He said he was a very modest man and had a great deal to be modest about. And that's exactly what's happened with the professional economists. You know, they were so confident about everything. And it turns out the world is more complicated than they thought.
What's your opinion about the economic theory MMT, especially the United States, because it's the reserve currency for the world?
Well, I think I think the modern monetary theorists are more confident than they ought to be, too. I don't think any of us know what's going to happen to this stuff. I do think there's a good chance that this extreme conduct is more feasible than everybody thought. But I do know if you keep just doing it without any limit, it will end in disaster.
If you can borrow money at a guaranteed low or even zero interest rate, is it still worthy of borrowing money for not that guaranteed cost from the insurance operation?
It reduces the value of float by a substantial amount. And we have a flexibility with our float that virtually no one has. And I've written about this in the annual letter. But the value of float has gone down dramatically because everything is off of interest rates. And when you get to negative interest rates, if a country can borrow at negative interest rates, you get into something that's kind of akin to the St. Petersburg paradox. And those of you who want to go to search, you can find some interesting things on it. But it becomes infinite. It's a crazy consequence of a bunch of abstract mathematics where you get there. But you lose gravity entirely. And you know, if you tell me that I'm going to have to lend money to the government at minus 2% a year, and I'm talking nominal figures, not, you know, you're just telling me how I'll go broke over time. if I do that, so it pushes you to do other things. And of course, we've seen it. Well, we saw the rest of the world do it in even more extreme fashion, but nobody, Paul Samuelson, brilliant man, nobody thought you could do this, and we don't really know what the consequences are. But we know there are consequences, obviously.
What impact does the rise of so many new SPACs have on Berkshire's ability to find and close new acquisitions?
Well, it's a killer. The SPACs generally have to spend their money in 2 years, as I understand it. So they have to buy a business in 2 years. If you put a gun to my head and said you got to buy a big business in 2 years, you know, I'd buy one, but it wouldn't be much of one. We look and look, and now there are, I don't know how many, whether it's hundreds, and there's always been the pressure from private equity funds. I mean, if you're running money for somebody else and you're getting paid a fee and you get the upside and you don't have the downside, you're going to buy something. And I could tell you about I had a very famous. I had a call from a very famous figure many years ago that was involved in it and wanted to learn about reinsurance. And I said, well, I don't really think it's a very good business. And he said, yeah. He says, if I don't spend this money in 6 months, I've got to give it back to the investors. So it's a different equation that you have if you're working with other people's money where you get the upside and you have to give it back to them if you don't do something. And frankly, we're not competitive with that. And that won't go on forever. But it's where the money is now, and Wall Street goes where the money is, and it does anything, basically that works. And SPACs have been working for a while, and you stick a famous name on it, you can sell almost anything. And it's an exaggerated version of what we've seen in kind of gambling done type market. In fact, I did have a quote from Keynes. This is probably one of the most famous quotes in history, because it really sums up the problem of the fact we've got the greatest markets the world could ever imagine. I mean, imagine being able to own parts of the biggest businesses in the world and putting billions of dollars in them and take it out of, 2 days later. I mean, compared to farms or apartment houses or office buildings where it takes months to close a deal, I mean, the markets offer a chance to participate and invest in earning assets on a basis that's very, very low cost, and instantaneous, huge, all kinds of good things. But it makes its real money if they can get the gamblers to come in, because they provide more action and they're willing to pay sillier fees and all kinds of things. So you have this incredible, huge asset to humanity, but it really makes its money when people are doing stupid things. I mean, that's where the money really is. And Keynes wrote this in 1936. It says 1939 on the slide, but he wrote it in 1936 in the General Theory, that speculators may do no harm as bubbles on a steady stream of enterprise. But the position is serious when enterprise becomes the bubble on a whirlpool of speculation. When the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. Well, the stock market, we've had a lot of people into the casino in the last year. You have millions and millions of people have set up accounts where they day trade, where they're selling puts and calls, where they, I would say that you had the greatest increase in the number of gamblers, essentially. And there's nothing wrong with gambling, and they got better odds than they've got if they play the state lottery. But they've had cash in their pocket, they've had action, and they actually have a lot of good results. And if they just bought stocks, they do fine and held them. But the gambling impulse is very strong in people worldwide, and occasionally it gets an enormous shove, and conditions lead to this place where more people are entering the casino than are leaving every day, and it creates its own reality for a while. And nobody tells you when the clock's going to strike 12 and it all turns to pumpkins and mice. But when the competition is playing with other people's money, or and if they're playing foolishly with their own money, but the big stuff is done with other people's money, they're going to beat us. I mean, we're not. That's a different game, and they've got a lot of money, so we're not going to have much luck on acquisitions while this sort of a period continues. But it's happened before. This is about as extreme as we've seen it, isn't it, Charlie? Or?
Yes, of course. I call it fee-driven buying. In other words, not buying because it's a good investment. They're buying it because the advisor gets a fee. And, of course, the more of that you get, the sillier your civilization is getting. And to some extent, it's a moral failing, too. Because the easy money made by things like SPACs and return derivatives and so on, you push that to excess, it causes horrible problems for the civilization. And it reflects no credit on the people that are doing it and no credit on the regulators and voters that allow it. So I think we have a lot to be ashamed of in current conditions.
But it's where the money is.
Yeah, but it's shameful what's going on.
Yeah.
It's not just stupid, it's shameful.
It's not. I don't regard it as shameful on a lot of the people that gamble. I mean, gambling is a very human instinct, and they've got money in their pocket, and they know somebody else that's made money who they don't think's any smarter than they are.
No, I don't mind the poor fish that gamble. I don't like the professionals that take the suckers.
Says if you deem stock prices to be overvalued or in a bubble, do you think it's best to keep your money in cash while waiting for prices to come down to a fair price? Or would it be a better idea to invest this money in some way while waiting until stock prices are fair again and then sell the investment to buy the stocks?
Well, Charlie and I have had that discussion on a lot of things. We bought some stocks we really don't know that much about, but I'm not really comfortable doing that.
You're used to shooting fish in a barrel, but that's gotten harder.
We've got probably 10 to 15% of our total assets in cash beyond what I would like to have, just as a way of protecting the owners and the people that are our partners from ever having us ever get in a pickle. You know, we really run Berkshire to make sure that we don't want to lose other people's money who will stick with us for years. We can't help what somebody does that buys it today and sells it tomorrow. But we've got a real gene that pushes us in that direction. But we've got more than we've got probably 70 or 80 billion, something like that maybe, that we'd love to put to work. But that's 10% of our assets roughly, and we probably won't get a chance to do it under these conditions. But conditions change very, very, very rapidly sometimes in markets, and we do have people that would like to join us, but the market option they have is too great for them. And if they're publicly traded, I mean, they basically can't. They would have great difficulty, then making a deal with us because somebody else would come along with using other people's money. It's, we may be unhappy about the 70 billion, but we're very happy about the other 700 billion. So it's not like we should complain.
You said you bought some stocks that you don't know a lot about. What are they?
Well, I will not get into naming what stocks, and it may be that there's some there that I think I know about that I don't know about. But we have bought stocks where Charlie and I mean, we know the business generally, but we don't have any insights. And they are, as a group, if I had to, if told me I was going to be shot unless I got the best result, I would rather own those stocks than the treasury bills we own. But on the other hand, we work with the quantities of money where if we put 50 billion into things that I'm kind of so-so about, but that are better than treasury bills, it doesn't, I'm not wildly comfortable about that, even though it can be undone. It's selling 50 billion to, when it's really attractive to buy something else. There's a lot of slippage that can happen in moving sums like that around. So that's something we talk about all the time. They're good companies. They're fine companies. But do we know something about those companies or have a way of evaluating that gives us an edge? The answer, I think, what do you feel about it, Charlie? We've talked about it a lot.
Well, of course it's a lot harder. And I think one consequence of this present situation is that Bernie Sanders has basically won. And that's because everything boomed up so high and interest rates so low. What's going to happen is the millennial generation is going to have a hell of a time getting rich compared to our generation. And so the difference between the rich and the poor in the generation that's rising is going to be a lot less. So Bernie has won. He did it by accident, but he won.
Could you and Charlie please elaborate on the higher order effect that these share repurchases have on society?
Yeah, their way essentially of distributing cash to the people that want the cash when other co-owners mostly want you to reinvest, and it's a savings vehicle. If the four of us sitting at this table decided we'd buy a few Dairy Queen franchises, we form a little company, and we all put in $1 million or something like that, and we buy the Dairy Queen franchises, and they're doing well. And three of the four of us want to keep buying more Dairy Queen franchises, and we're not done building and saving for the future. And we're in the wealth creation business. And the fourth one says, "Listen, I've gotten rich enough. I'd rather take some money out." And well, there's only two ways to do it. We can pay dividends, all four of us, three of us of whom don't want it, and we can repurchase the shares at a fair price. If it's just the four of us, we pick out a fair price, and the fourth one gets bought out of his interest. I find it almost impossible to believe some of the arguments that are made that it's terrible to repurchase shares from a partner if they want to get out of something, and you're able to do it at a price that's advantageous to the people that are staying, and it helps slightly the person that wants out, and a majority of the Berkshire shareholders, a great majority. We had a vote on dividends one time. We've got savers. Now, that's partly because we've advertised ourselves as being that sort of a vehicle. We've created that something. We've stuck with it for 50-something years. And people look, individuals, huge number, look at Berkshire as something they're going to own until they die. Now, their circumstances may change, their needs may change, but the savers generally keep saving. We just recently had somebody that father came with us 60 years ago, and billions of dollars, and they weren't saving exactly for their old age. Just was sort of built into them that they like to do it. Now philanthropies will get a lot of money and so on. And, it's the most. What could be more logical than if a very small minority of your holders want to get out, and most of them want to stay in, and the person who wants to get out wants the money. You don't give the money to everybody. You give it to the one who wants it, and you do it at a price that is beneficial to most parties. On a private deal, you'd work out the fair value. The market tells you the value in the case of a publicly traded company. Charlie, got anything?
Well, if you're repurchasing stock just a bullet higher, it's deeply immoral. But if you're repurchasing stock because it's a fair thing to do in the interest of your existing shareholders, it's a highly moral act. And the people who are criticizing it are bonkers.
If Berkshire would switch its capital return policy to dividends from buybacks, if the capital gains rate goes up to 43.4%, dividends would be far more tax advantaged for shareholders under that scenario.
Yeah, we literally did have a vote by our shareholders. Now we've got a different group of shareholders than a REIT would have, or an MLP might have. I mean, there's different people select what they go into, and people that go into SPACs are hoping the stock goes up next week. Basically, and we've got a bunch of people that were assembled over 55 years, but they started with a base of people that it was a lifetime investment, and if they wanted to cash out, they thought they'd get a fair price at that time, but they really didn't. They had bought it with no intentions like that. So we had a vote, and it was something like 97% or something of the shares said they don't want a dividend. And now that wouldn't be true at other companies, and it'd be crazy to be paying a regular dividend like Coca-Cola has done for many years, and then all of a sudden change the policy on millions of people who had bought it with one expectation in mind and try and change it into a different animal. But Coca-Cola isn't going to change to Berkshire, and Berkshire isn't going to change to Coca-Cola. We've got a different group of owners, and it will keep self-selecting because people have a choice every day. which do you want to, sort of thing do you want to be in? And Berkshire is a certain kind of animal in that respect. If they jig around the tax laws, that's really got nothing to do with the decision. I mean, we've got a very substantial majority of people that want us to reinvest the money, and what they're more concerned about is whether we find something to do with the money, the $100 billion or something. And repurchasing shares is something that helps them. They own a larger percentage of Berkshire as they go along, and they'd love to see us buy another business, but they don't mind us intensifying their interest in the present business.
What are your thoughts on the new administration's capital gains, corporate tax, and stepped-up basis tax increases?
If Charlie wants to answer that, I'll be glad to have him do it. I long ago, many times, have said that I don't put my political opinions or anything in a blind trust when I take this job, but I also don't speak for Berkshire Hathaway. I mean, we've got people that have very different views on taxes, and I've expressed some things in the past. But I don't like to speak on behalf of, when I'm sitting at a Berkshire Hathaway annual meeting, presumably speaking for Berkshire. I don't really like to get into political questions generally, and I don't really think I should. But I also think if somebody asks me who I vote for the last elections on a personal basis, I voted for Biden. But I've never asked a single employee of ours who they voted for, anything of the sort. What religion? I am not authorized to go around signing my name as chairman of Berkshire Hathaway to proposals. If I write op-ed pieces, I do it as an individual. I try to make it clear. So I don't want to use the meeting to give a lot of views on taxes. Charlie?
No, but I think it's probably a mistake to be basically anti-capitalist. I think capitalism is what raises GDP for everybody. And I have also a feeling that Benjamin Franklin was right when he said that it's hard for an empty sack to stand upright. And to some extent, the prosperity of leading American institutions helps them behave better. Now, there are exceptions in promotional finance and so on, but by and large, Franklin was right. And so I'm a little wary of just constantly being mad at people because they have a little more money.
What are your thoughts on those people leaving? What keeps you in California?
Well, that's a very interesting question. I frequently said I wouldn't move across the street to save my children $500 million in taxes. And so I have, that's my personal view on the subject. But I do think it is stupid for states to drive out their wealthiest citizens. The old people that don't commit any crimes, they donate to the local charity. Who in the hell in their right mind would drive out the rich people? I mean, Florida and places like that are very shrewd, and places like California are being very stupid. It's contrary to the interests of the state.
How will a 25 to 28% corporate tax rate affect Berkshire's companies?
Well, I don't think it would be the end of the world. We've adapted to the tax rate, whatever it is.
Yeah, I would say that if they raise the tax rate, they're owning the federal government's owning a larger percentage of business. I'm not saying what the tax rate is, but we have a Class A stock and a Class B stock. The U.S. government owns what I call the Class AA stock, and it's a very special stock. They get a percentage of the earnings, but they don't own the assets, and they don't vote on who gets to run the place or anything else. But if the government wants to take, when I was first starting, they used to take 52%, the federal government did, of corporate profits, and they've got, what would you pay to own the government's Class A, AA stock? If there was a public issue by the U.S. Treasury and they said this vehicle, given a name like SPAC or something even sexier, and all it will do is it owns the future tax payments of Berkshire Hathaway forever. And how much is that stock now worth, and it'll pay a big cash dividend, and they'll go up as we retain earnings and build the company and everything else. Well, it's worth more if the tax rate is 25% or 28% or 52% than at 21%. They own a special stock, and when people talk about how it all gets passed through the customer and everything, in the utility business, it actually does. That's a special case. But it doesn't in most of our businesses. I mean, it's a corporate fiction when they put out statements about the fact that this will be terrible for all of you people. We pay more taxes. It hurts the Berkshire shareholders if rates are higher, and that may be quite appropriate. But to say otherwise is just it doesn't make any sense. I would love to see the government actually issue. They could have. I mean, they could set up a company, just call it the Berkshire Hathaway Tax Company, and it would take all the taxes we paid every year. How much would they be able to sell that asset for? They talk about unfunded obligations of the government. That's an unreported asset of the federal government. They own part of Berkshire, and they get to determine how much. I mean, it's an interesting question.
In the owner's manual portion of your annual report, Warren, you state, on my death, none of my stock will have to be sold to take care of the cash bequests I've made or for taxes. Would the recent Biden proposal to treat unrealized gains as sold and taxable at death at a 43.4% rate change the amount of stock required to be sold for payment of taxes upon your death?
Yeah, well, the tax law can be changed tomorrow. And it can be done a lot of different ways, and it's been done a lot of different ways in the past. I can tell you, I can actually make a promise to society that 99.7% of what I have when I die will either go to philanthropy or to the federal government. And the federal government can actually determine the rules on that. And I would prefer that it would go to philanthropy. I think it actually will accomplish more utility if it goes to be used by some smart people in philanthropy than if it simply reduces the federal debt by $100 billion or something when I die. I don't think it makes a damn bit of difference. Whether the federal debt is $100 billion higher or lower, it won't change anything in the world. And at present days, it doesn't really save them anything because they can borrow $100 billion. It doesn't cost them anything anyway. But that condition won't prevail. But I would not regard it. I'm just talking personally. I'm not advocating this public policy, but I wouldn't. If they took it all, it would not bother me. I mean,
I guarantee it won't bother you.
Yeah, that's what Charlie was. Charlie says you won't know. But if you decide, if American democracy decides that it's better to take it all, which I don't think they will, and I don't think they should, but nevertheless, so what? And I would like to see it used to accomplish the most for humanity. I mean, and that means having smart people, properly motivated, and more importantly, not improperly motivated, distribute it in a way, and who knows what the hell it would be 10, 20, 30, or 40 years from now. I do know if it goes to the government, it reduces the national debt by that amount. I don't think it changes whether they change minimum wage laws or does anything else. I just think a little figure changes. It'll be, it'll show up in the budget one day, received from Buffett, X, and then some huge figure appears down below. I don't think it really. So I would prefer it be used privately, but that's really up to the people of the United States to decide through their representatives.
Mr. Jain, what has COVID-19 taught us about systemic and correlated risk, and is there anything that we will do differently from now on?
Yeah, in the insurance business, we often think about pandemic risk as one of the risk factors that we need to cope with in our business. Having said that, I think the big lesson for us, having gone through what we've gone through recently, is that while we were aware of the fact that pandemic risk is a risk factor, it was totally underpriced by all of us in the industry. Several of us thought it's an event that will happen at most once in 100 years. And even then, those odds are pretty high. So I think the big lesson for us is to recalibrate and rethink about what the return time is for something like a pandemic risk. And separately, we haven't yet done a good enough job as an industry, I'm saying, in terms of correlating the risk and aggregating the risk and making sure we can deal with the aggregate numbers. For example, pandemic risk has obviously taken people's lives, but then separately a bunch of us used to write something called event cancellation or contingency policies. And in terms of pricing for the contingency policies, like the Olympics being canceled, NBC would buy insurance for their rights, which might suddenly be not worth much. And when pricing something like that, we would think in terms of earthquake and risk and more recently terrorism, but we would never factor something like what portion of the price should come from the pandemic exposure. So I think the industry will become a lot more sophisticated in terms of thinking through what is the impact of pandemic risks across the entire portfolio, as opposed to it just being localized to one or two areas.
As Ajit mentioned, people were throwing in, an event cancellation. I mean, lots of people buy insurance against the Olympics being canceled or the United States not participating. I mean, they try to think of all kinds of risks because they have ad campaigns based upon all. So there's a lot of event cancellation insurance, and it was probably underpriced the implicit part of that premium that was attributable to a pandemic risk. I mean, Bill Gates gave a terrific talk at TED 5 or 6 years ago, and people ignored it. It's very interesting because this isn't a worst case what we've seen, and yet it's staggering in terms of what has happened, and people that wrote insurance that they may have found out sometimes that they were covering things they didn't even intend to cover, and maybe the insurance didn't think they were buying, but nevertheless, after the event occurs, that they get very inventive in coming after them. There are certain risks too that are just too big. The nuclear risk, for example, I mean, the federal government is very early on, they recognized that the private insurance industry, they can't handle the risk involved in the financial risk that would be involved in terms of a massive nuclear strike or something like that. So it's the pandemics. The wording will be much more careful in future policies on trying to define it very precisely. And incidentally, I mean, in the way the cases have come so far, in the United Kingdom, I mean, and I think there was one particular insurer. I mean, the cases are coming down much tougher on insurers. In the United States, I mean, the policies were just written differently. You don't get insurance against something you don't buy against for, and generally the court decisions have come down favorable to insurers, and at Berkshire, it just so happens we are not a big player, but that's in commercial multiple peril, which might be where it is not a huge factor for Berkshire.
What's your best estimate of Berkshire's insurance claim exposure from the COVID-19 pandemic?
Well, in terms of reserves, starting from last year to the end of the first quarter this year, we have put up $1.6 billion and change in terms of reserves. Now, what that doesn't take into account is some of the frequency benefit because of COVID-19 that results because of fewer accidents, and GEICO has had a huge tailwind because of that. So, but in terms of what the insurance operations collectively are going to be writing checks for, that number, as of now, is about $1.6 billion. And my guess is that will probably grow. Because if you look upon it, the industry as a whole has reserved, we've reserved 1.6, as I mentioned. The industry as a whole has reserved about $25 to $30 billion for COVID-19 as of now. If you believe the pundits in the industry, they will tell you that number is probably going to be closer to $100 billion. So there's another about $75 billion of COVID-19 losses that need to flow through insurance industry's balance sheet and income statement. Our number, therefore, of 1.6 that we have as of now is going to be a lot higher, but it's not something that we cannot manage completely.
yeah, we will not be in the top 5
Right.
payers of, my guess, of insurance claims, even though we write a much smaller amount of both life insurance and annuities, actually. And in the end, we had more life insurance claims, but the annuities are not going to last. More people will have died that would have otherwise got payments under annuities. It cuts a lot of ways. It's one of the great human catastrophes of all time, but it is not. It's not that big an insurance. And I would say this: if the insurance industry thinks they're going to lose $100 billion, the $100 billion ought to be up on their books now. I mean, the idea of feeding in losses, you've got a liability, and our goal is not. Our goal is to put up the liability when we think it's happened, and then if we should not be at $1.6 billion, I would say this: if we really think we're going to have some proportional share of $100 billion, well, that's enough said on that.
What does the combination of Kansas City Southern with either Canadian Pacific or Canadian National mean to BNSF in terms of competition? And do you think the synergies of the merger will justify the multiple paid?
It's obviously a transaction we followed very closely with both Canadian National and Canadian Pacific bidding to purchase Kansas City Southern. Either of those companies acquiring Kansas City Southern will have an impact on BNSF. What they're basically proposing is to create a north-south railway that goes from Canada into Mexico. We do have a strong presence in Mexico, not as strong as some of our competition, but we would feel competition there. So we'll follow that transaction very closely. As it goes before the Surface Transportation Board, the standard that will be applied is that competition has to be protected or enhanced. So that's our opportunity to protect our franchise on behalf of our customers. So we move intermodal business both in and out of there on behalf of certain customers. We'll want to protect the rights of our customers there. So we'll be active in the approval process, but there's no question in the end it impacts our franchise. Warren?
Yeah, it's not huge, but it affects both the Union Pacific and BNSF to a small degree, a relatively small degree, but that's not really the worry of the Surface Transportation Board. Their job is to do what's best for the shippers, and in terms of the price that's being paid, like you say, if you can borrow all the money for nothing, it doesn't make much difference to people, and this would not be being paid under a different interest rate environment. I mean, it's very simple, but it would make. There's no magic to the Kansas City Southern. It's got I think their deal with Mexico ends in 2047, and that I mean, it will the number of carloads carried, everything, it's not going to change that much. But it is kind of interesting. There's two major Canadian, what they call Class 1 railroads, and there's 5 in the United States, and this will result, in essentially 3 of the units being Canadian, 4 being U.S., which is not the way you normally think of the way the development of the railroad system would work in the United States. But it's, we've talked about it plenty, and CP or either Canadian Pacific or Canadian National is very likely to get it. I think the Surface Transportation Board voted for it didn't they, the other day? Didn't get. Am I correct on?
They voted on an initial trust structure that they had to approve for Canadian Pacific, and that was a 4-1 vote, as you noted, Warren. So yeah. They're moving forward with the evaluation of it.
Yeah, and normally railroad deals are very long take a long time for them to evaluate. But in this case, I think they have two opposing trust proposals, and in effect, by making if they make a quick decision on which trust proposal that they allow, I don't say how you allow two proposals exactly. So it may be a very accelerated decision. I don't know, but it's up to the Surface Transportation Board to do what's best for what their obligation is to the country to do.
On that, do you
Sure.
think the valuation that they're paying is worth it?
In a very, very mild way. I mean, everybody's contemplated making deals with different railroads, ever since I've been in the railroad business. We've talked about it. When CP, when was Hunter Harrison came after, was it Hunter that did on CP that kind of led the way, and we looked at buying CP. I mean, everybody looks at everything, and we would not pay this price, and it implies a price for BNSF that's even higher than what the UP is selling for. But it's kind of play money to some degree. I mean, when interest rates are this low, and I'm sure from the standpoint of both CP and CN, there's only one KC Southern, and they're not going to get a chance to expand it. They're not going to buy us. They're not going to buy the UP, and the juices flow, and the prices go up, and
They're buying with somebody else's money.
yeah, it's somebody else's money, and you're going to retire in 5 or 10 years, and people are not going to remember what you paid, but they're going to remember whether you built a larger system, and the investment bankers are cheering you on at every move. They're saying you could pay more, and this is they're moving the figures around, the spreadsheets are out, and the fees are flowing.
In this year's chairman letter, you discussed that you made a mistake in 2016 when calculating Precision Castparts' average amount of future earnings, which resulted in Berkshire overpaying to acquire it. It appears that Precision's earnings declined substantially in 2020 because of the pandemic and the effect of airline and travel industry. What calculations could you have made in 2016 that might have altered your decision to acquire it? And secondly, are the problems Precision is currently facing larger than the pandemic?
Berkshire didn't make the mistake. I made the mistake, incidentally. Anytime we look at buying a business, we're evaluating the competitive strengths of the business, the price we have to pay, the management we get, and everything. And we didn't make a mistake on the management, but in terms of the earning power on average, and when Boeing has troubles with the MAX, well, that's a probability. I mean, anytime any customer is a big, I mean, all kinds of things can happen, and we have seen some of those things happen, and therefore, I paid too much in relation to average earnings. It's a terrific company, I'm happy with the management and everything, but GE doesn't need as many engines as we thought they would need, and they get into the power business and a variety of things, and we knew they're in the businesses, but we did not think those businesses would necessarily be in something close to a depression when other businesses that we bought end up sometimes doing better than we think. But we'll continue making mistakes. I mean, and I shouldn't say we will. I will. But even these other guys.
The rest of us will help.
We've got some wonderful deals and some terrible deals, and the nice thing about it is, as I pointed out, this doesn't really apply in the case of Precision precisely, but when we're disappointed in a business, it usually becomes a smaller and smaller percentage of our business just by the nature of things, because it isn't going anyplace. And when we get a successful business like a Geico or something of the sort, Geico's they're doing 15 times as much business as when we bought control in 1990. They become a proportionally much more important part of our mix. So you really get, through just natural forces, you get more of your money in the things that have developed more favorably than you thought. You actually end up getting a greater concentration in the ones that work out. It's not like as Charlie would say, it's not like having children. I mean, the ones the bad ones cause you more problems, but in the children of businesses, the small ones kind of. By the way, we started with 3 businesses, Charlie and I, and Berkshire was textiles, diversified retailing was a department store, and trading stamps were Blue Chip's business. And those were the 3 companies we put together, and all 3 of the original businesses failed, which sort of gets me in terms of the people that are worried about don't we know that coal is going to be phased out over time? Of course we know coal's going to be, but that doesn't mean we're going to be phased out over time. I mean, that every business has some things to think about that way. The biggest danger, they have that section in the prospectus called, what do they call that? About certain
Risk factors.
but risk factors, yeah. The number one risk factor, you never see it. The number one risk factor is that this business gets the wrong management, and you get a guy or a woman in charge of it that they're personable. The directors like them. They don't know what they're doing, but they know how to put on an appearance. That's the biggest single danger that a business, and that person stays and runs it for 10 or 15 years and either stays in the textile business or department store business and expands. I've looked at a lot of businesses, and that's what's caused the number one problem. And it isn't the kind of thing where they list them all because the lawyers tell them to list them.
Now that the crypto market overall is valued at $2 trillion, do you still consider cryptos as worthless artificial gold?
Well, I knew there'd be a question on Bitcoin or crypto. And I thought to myself, well, I've watched these politicians dodge questions all the time, and I always find it kind of disgusting when they do it. But the truth is, I'm going to dodge that question because we probably got hundreds of thousands of people watching this that own Bitcoin, and we probably got 2 people that are short. So we got a choice of making 400,000 people mad at us and unhappy, or making 2 people happy, and that's just a dumb equation. So I thought about it. We had a governor one time in Nebraska, and a long time ago, but he would get a tough question. What do you think about property taxes, or what should we do about schools? And he'd look right at the person. He'd say, "I'm all right on that one," and then he'd just walk off. Well, I'm all right on that one, and maybe we'll see how Charlie is.
Well, those who know me well are just waving the red flag of the bull. Of course, I hate the Bitcoin success. And I don't welcome a currency that's so useful to kidnappers and extortionists and so forth, nor do I like just shuffling out a few extra billions and billions and billions of dollars to somebody who just invented a new financial product out of thin air. So I think I should say modestly that I think the whole damn development is disgusting and contrary to the interests of civilization. And I'll leave the criticism to others.
I'm all right on that one.
Elon Musk has stated that Berkshire Hathaway's energy proposal for Texas, spending more than $9 billion for new generating capacity, is wrong. Instead, Mr. Musk argues that load balancing using battery storage is the appropriate course of action. Can you explain why the BHE proposal is the better course of action for Governor Abbott in the state of Texas? Specifically, what amount of savings can the citizens of Texas expect above and beyond what Mr. Musk is proposing?
Obviously, there is a very unfortunate event in Texas in February, and it basically lasted 4 days. Many lives were lost. The economic damage was significant. Texas has highlighted that anywhere from 80 to $130 billion in incurred losses over that period of time. And I think when you look at the power sector, it fundamentally let the citizens down. It didn't perform as they expected. And then when it did perform, it was extremely expensive. They incurred billions and billions of dollars of energy costs versus a multiple of basically 10 times what they paid. They paid 10 times in energy costs over those 4 days what they paid in the past year. So a very substantial event for Texas. We've gone to Texas with what we believe is a good solution. We spent a lot of time pulling it together, understanding the fundamental issues around it. And our proposal is really based upon the fact that the health and welfare of Texans were at risk, and we needed to have effectively an insurance policy in place for them, that if they needed the power on very short notice, it would be able to be dispatched and it would be there for the 4 days. We're actually proposing it could be there for 7 days. And the fundamental concept of our proposal has always been, if there's a better proposal that's brought forward, we've accomplished our mission. We've just been really there to, it's the best proposal or option we could come up with, and obviously if Texas or Elon or someone else comes up with a better proposition, we've always said, Texas, you should pursue it. We strongly believe right now we have what remains is a very good proposal for Texas, and it'll continue to be discussed and evaluated. The big difference between a battery proposal and our proposal is that we will have power that can be generated continuously for 7 consistent days, where if you went to a battery solution, you may release that power that's been stored for 4 hours, but we're talking 4 days of a problem, not 4 hours. And it's just a completely different cost equation and solution. So very proud that our teams brought forward what I thought was a very unique solution. We've worked hard with our suppliers and Peter Kiewit and Sons to put together what we believe is a firm cost that can also be delivered by November of 23. So again, we put a firm date on. It won't be ready next winter, unfortunately. It won't be ready this summer. But it's a valuable solution, and one that we hope at least leads to the right discussion and the right long-term solution for the state.
Yeah, and we're also willing to put up $4 billion that if we don't deliver when we say we're going to deliver, we'll pay it as a penalty, basically. But you know, we went to Kiewit, we went to General Electric and said, you know, how long can we get turbines? And, you know, for that, you know, if you're going to be prepared for 2023, you have to start at a point fairly soon, and you have inflation going on, and Kiewit's not going to change things on us in a month. We don't try to get the contracts all written out, but they had 100 people working on it.
Yeah, they had hundreds working on it.
and you know, and GE's cooperative and everything. But doesn't mean we have the best solution. We just know what we can do, and if anybody can do it faster, they can do it cheaper, you know, whatever. That's terrific. But they should have something to lose, though, if they don't do it. I mean, and we will back our promise up by $4 billion, which, you know, and we won't have any rinky-dink clauses in there that if this happens or that happens, we don't pay. Well, but we won't be able to do that a year from now. I mean, we can do it a year from now with the costs then from what they are then, and then it'll be a year further out. We want Texas. Texas is a terrific place to do business. We do a lot of business there, and it's where BNSF is headquartered. And it's a great place. And this was out of the blue, but one way or another, the nature of utility business is that you have to be prepared for something that probably isn't going to happen. And you know, you don't want to say it's a 1 in 30-year event, you know, and people die. I mean, you want a margin of safety in it, and we've got one solution, and other people may have other solutions, and we will cheer when a solution is reached of any kind, and we will cheer a little louder if it's ours.
Suppose the hypothetical situation arises where Warren Buffett calls you on the phone to tell you that Elon Musk has contacted him about writing an insurance policy on his proposed mission to and subsequent colonization of Mars. Specifically, he wants insurance to insure his SpaceX Heavy rocket, capsule, payload, and human capital. Would you underwrite any portion of a venture like that?
This is an easy one. No, thank you. I'll pass.
Well, I would say it would depend on the premium, and I would say that I would probably have a somewhat different rate if Elon was on board or not on board. I mean, it makes a difference. I mean, if somebody's asking you to insure something, so I would. That's called getting skin in the game, and
But in general, I would be very concerned about writing an insurance policy where Elon Musk is on the other side.
Okay.
Tell Elon to call me instead of the Jeep.
You mentioned that the best investment results come from the companies that require minimum assets to conduct high-margin businesses. In today's world, many of these companies tend to be software-driven businesses. While Berkshire has avoided investing in high-growth technology companies in the past, this appears to be slowly changing with your investments in Apple and Snowflake. As shareholders, should we expect that high-margin businesses will begin to constitute a larger proportion of Berkshire's investment portfolio over time, particularly as Todd and Ted take on larger roles in the investment decision process?
We've always known that the dream business is the one that takes very little capital and grows a lot. And Apple and Google and Microsoft and Facebook are terrific examples of that. I mean, Apple has $37 billion in property, plant, and equipment. Berkshire has $170 billion or something like that, and they're going to make a lot more money than we do. They're in better business. It's a much better business than we have. And so, in Microsoft's business is a way better business than we have. Google's business is a way better business. We've always looked. We've known that a long time. We found that out with See's Candy in 1972. I mean, See's Candy just doesn't require that much capital. It doesn't have. It has obviously a couple of manufacturing plants. They call them kitchens, but it doesn't have big. It doesn't have big inventories except seasonally, for a short period. It doesn't have a lot of receivables. So those are the kind of businesses. They're the best businesses, but they command the best prices too. And there aren't that many of them, and they don't always stay that way. So we're looking for them all the time, and we've got a few that are pretty darn good, but we don't have anything as big as the big guys. But that's what everybody's looking for. That's what capitalism is about: people getting a return on capital, and the way you get it is having something that doesn't take too much capital. I mean, if you have to really put out tons and tons of capital, the utility business that way, it's not a super high return business. You just have to put out a lot of capital. You get a return on that capital, but you don't get fabulous returns. You don't get Google-like returns, or anything remotely close to it. We're proposing a return in the transaction with the proposition with Texas. I think it's a 9.3%.
Yeah, 9.3.
Yeah, and that. But if you look at the return on most American businesses on net tangible assets, it's a lot higher than 9.3. But they aren't utility businesses either.
We are grateful for their efforts, but Todd and Ted are still not made available to shareholders at the annual meeting each year. Given their growing importance to the firm, can you discuss this policy and whether we can expect to hear from them more in the coming years?
They're both absolutely terrific, and that's one reason I don't want people quizzing them on stocks. They are assets of Berkshire, and just there's no reason for them to be out educating other people on how to compete with us. And it wouldn't. It always seems so silly that people expect. They don't expect Merck or Pfizer or something to tell them exactly what their scientists are working on, where they stand and where the failures have been, so they can eliminate those. If you've got talent that knows how to evaluate businesses, and those two fellows they've gone far beyond that. They're terrific assets, and they love Berkshire, and they work extraordinary hours. But we don't really want them going around with people asking them questions about why you like this industry better than that industry or anything of the sort.
What are your current thoughts on China and whether the communist leaders will allow businesses with strong leadership to flourish in decades to come?
Well, I think that the Chinese government will allow businesses to flourish. It was one of the most remarkable things that ever happened in the history of the world when a bunch of committed communists just looked at the prosperity of places like Singapore and said, the hell with this, we're not going to stay here in poverty, we're going to copy what works. And they changed communism. They just accepted Adam Smith and added it to their communism and said, now we have communism with Chinese characteristics, which is China with a free market with a bunch of billionaires and so forth. And they made that shift. They deserve a lot of credit. Warren and I are not quite as good at that as changing our minds in many cases.
Yeah.
And that was a remarkable change coming from such a place. And of course, it's worked like gangbusters. It had this enormous growth in the average income of the average Chinese. They've lifted 800 million people out of poverty fast. And there was never anything like it in the history of the world. So my hat is off to the Chinese. And I think they will continue to allow people to make money. They've learned it works. The Chinese, I loved what the guy said in the first place. I don't care whether the cat is black and white as long as it catches mice. That's my kind of talk.
In that list of the 20 most valuable companies, just 3 are Chinese. Now, if you're looking out 30 years, how many do you think will be Chinese? My guess is more, but I don't think they'll top the United States. But who knows? It's amazing what has been accomplished, and
Yeah, really amazing.
and they found what works. I mean, there's nothing like finding something works in order to sort of reinforce ideas over time, and we'll see what happens. But I would bet there will be more than 3, but I will bet the United States has more than China has, too.
President Joe Biden's $1.9 trillion American Rescue Stimulus Plan. This is the least responsible macroeconomic policy we've had in the last 40 years. Your thoughts?
You're asking me on that?
He didn't write to who, so I guess it's anybody on the stage.
I would say that Larry's been reading his uncle's book, which was Paul Samuelson. But no, Larry is a very, very, very smart fellow, and he's laying out possibilities which actually now have probably been voiced a little more even since that March 19th, or whatever date it was that he made that. You can't just do one thing in economics, and if we really could shovel out more and more debt, and the carrying cost turned out to be something very good. People thought Japan couldn't do what they've done, but it used to be called the Widowmaker, and around Solomon, and people were shorting Japanese bonds, but the answer is we don't know. But Larry's view is an important view, and it's just as good as, in my probably as the view on the other side might be. We don't know what happens from the present policies. We do know, as Jay Powell said the other day, the idea that 100% of GDP was some terribly dangerous level for in terms of debt, and that doesn't really make a whole lot of sense now, and that used to be kind of accepted wisdom. We've learned that a lot of things we thought before weren't true, but what we haven't learned yet is whether what we're doing now is true. And the best thing to do is recognize you don't know and proceed in a way where you get a decent result no matter what happens, and that's what we try and do at Berkshire Hathaway. We do not think we can make money by making macroeconomic predictions. We do think we can be pretty darn sure we'll get a reasonable result under policies that will not maximize result if we could do that sort of thing.
It's not at all clear whether Larry is right or wrong, and
he's a smart man, though.
He is a smart man.
Yeah,
and it's courageous of him to raising it to. He's practically the only one talking that way, which I admire, by the way.
Yeah, it guarantees he won't get a position in the administration.
Yes. Well, that's one of the reasons I admire him.
Yeah.
And not that there was anything wrong with having position in the administration, but I think people who kind of tell it the way they think it is, I like it.
Could you please explain why you decided to exit most of your bank stocks in 2020, except for Bank of America? And what's your view on the future of the banking industry?
I like banks generally. I just didn't like the proportion we had in it compared to the possible risk if we got bad results that did not. So far, we haven't gotten. So we were over 10% of Bank of America. It's a real pain in the neck to both to the bank and more to the bank than to us if we go over 10%. There's just a whole lot of, and I like the Bank of America. I mean, I like Brian Moynihan very much, and I like the banking business fine. So we took that up, but we took the overall bank position down. We didn't want to go above 10 in any of the others, and we did want to increase the B of A position, but we overall didn't want as much in banks as we had. We like the banking business is way better than it was in the United States in 10 or 15 years ago. The banking business around the world, in various places, might worry me, but our banks are in far, far better shape than 10 or 15 years ago. But when things froze for a short period of time, the biggest thing the banks had going for them is that the Federal Reserve was behind them. And the Federal Reserve they're not behind Berkshire. It's up to us to take care of ourselves.
You recently purchased a large stake in Verizon. For educational purposes, could you please explain your thinking behind this investment? In general, many people see telecoms as dumb pipes that have to spend heavily on CapEx building out the 5G infrastructure, only for the other tech companies to take advantage and capture most of the value created from the infrastructure, like Facebook, Uber.
I think he's analyzed the situation well, but we are not in the business of explaining why we own a stock which we either might buy more of or sell or who knows what. So he's on his own, but he sounds like he's very capable of thinking it through very well himself.
Has Berkshire's board already discussed what would happen to the company over the long term if Berkshire was to be prevented from acquiring controlled businesses?
We don't discuss that as a specific, but the board is very, very, very familiar with what Berkshire does, why they do it, how we think in deploying capital. But we could, everybody knows that if you change the antitrust laws, it can change things for Berkshire. If they change the tax laws, it can change things for Berkshire. There's a lot of things, and we could spend hours discussing them. But in the end, is it a 22.3% risk that something changes? It's a good way to fill the time at board meetings. And if you're getting $300,000 or $400,000 a year as a board director, you might want to spend your time doing that. But we really don't focus on that. The main thing about Berkshire is how do you preserve the culture? How do you make sure that if you get the wrong person as the CEO, you can do something about it? That's the biggest risk a board has, is if you pick the wrong CEO. And I've been on 20 boards, and it's happened more than once. And sometimes it's a terrible problem to get rid of them. Years go by, and if a dissident comes in, it's one thing. But if you just sit there and you collect your $300,000 or $400,000 a year, and the chief executive keeps proposing you get an increase time to time, and it's worse yet if he's a nice person, doing his best. But we're not going to spend a lot of time. We may do it on a personal basis, but we're not going to take a lot of people. And we want them to know more about what's going on with BNSF and how Katie's doing, and whether the KCS thing can injure us in any material way, and so on. And we really don't, except maybe on a private side thing, we don't start talking about what the effects will be in 2050 if this projection or that projection is met.
Why does Warren say Berkshire's ability to insure enormous risk quickly is a less valuable asset than it used to be?
Because the demand is less. I mean, basically on that. If you take a period like happened after 9/11, I remember, I may be wrong in the details of this, but Cathay Pacific, for example, they couldn't land in Hong Kong, as I remember, unless they had an insurance policy by Monday of the following week. Well, we can do it. I mean, G calls me up and he thinks of a price and I think of a price, but we can do it. We can take the loss if it happens. They called us on the Sears Tower, I think, back then. After that, nobody knew. They didn't know whether bombs might be placed all over. And they wanted more insurance all of a sudden, and we gave them a price. That sort of an environment hasn't really persisted. I mean, there were times, I think, perhaps AIG, when Hank Greenberg was there, he would do the same thing. But there weren't 10 or 20 people out there, and they needed big limits in some cases. And we were good for it. And they knew that if they bought the insurance and it happened, that we'd write a check and it would clear.
In addition to the demand side, the supply side has become a lot more competitive as well. There are a lot of people who can put up big limits, not as much as we do, but they can syndicate a program and put up $1 billion very easily. So that competitive advantage we still have, but it's no longer as big a deal as it used to be.
Warren, Charlie, and Greg's views on how Kraft Heinz has performed over the last 12 months compared to the disappointing performance pre-COVID.
I think that Greg's on the board, so I don't know that we're in a position to give advice on Kraft Heinz. We do, we entered in effect a semi-formal partnership with 3G many years ago when it was just the Heinz deal, and then went on to acquire Kraft with our partners, and they've done more than they hold up their share of things, and we do what we said we do going in, which is to be a financial partner, and they're more of the operating partner, although we participate to a degree in any big decisions, and they would listen to us. But we're not making any in terms of Kraft Heinz stock. That's up to somebody else to evaluate.
I think we're very comfortable with the fact that they put a strong manager in place in Miguel, and he's put a very good team in place at Kraft Heinz. So we're pleased with the leadership and management team in place. They're very focused on how they're executing as they've gone forward and rationalizing their capital structure and managing down their debt structure. So very pleased with the path forward with the existing management team.
We feel better about this is a more general subject, but one of the subjects I might write about in one of the future annual reports is the problems caused by the myths that people have about their own organization. And I've seen that so many times in various forms. And to some extent, the problem has become accentuated in the last 20 or 30 years because the CEO often and works with the investor relations, and they say, well, we have to have constant contact with the analyst community, and of course, so they go on every couple of months and they repeat certain things about their company, and it becomes part of sort of the catechism. And nobody's going to go on 2 months after the CEO has said one thing and say, well, actually, that really isn't the way. They're not going to contradict themselves or change course. And so if you get these myths, and they can occur in a lot of different ways. I can give a lot of examples, which I won't do. As I tell my friends in corporate America, I really am not going to squeal on them. But there's a lot of mythology that gets handed down from one CEO to the next. Can the succeeding CEO say the guy that picked him, was on the wrong course, or he's been telling you something that isn't really quite true? He can't do it, And then he starts repeating it, and it leads to enormous errors. But it's hard to tell the story without giving examples, and I don't like to give examples. So we'll see whether I write about it sometime. Charlie, you probably got some thoughts. He's had a ringside seat at a lot of. He's been on boards that I haven't been on. I mean, and it doesn't just extend to business. It goes beyond that, into education and to, a lot of areas.
What's really interesting is the way you prattle out all the time. You're pounding back in even if it's wrong. And so one of my favorite remarks in the history of human remarks was by Sir Cedric Hardwicke, who is a great British actor. And he said, "I have been a great actor for so long that I no longer know what I truly think on any subject." And I think that happens to a lot of people. And it happens to virtually every politician.
And it gets embedded in corporations.
Gets embedded and so on.
And the trouble is now the CEOs speak out so often, so if they've got some crazy thing that they're saying about their company and they keep repeating it, the subordinates aren't going to contradict it. And Charlie said they just believe it after a while, and it's dangerous.
Yeah, and of course the young people get these ideas after their liberal educations. Think that God has given them direct insights, and they're just as crazy as the politicians.
Now, there's some old people that have them too.
Yeah, well, the old people are already crazy, but
they're going to die sooner. So
we have our old insanities. The new insanities are the young get.
Could you tell us what happened to the joint venture between Berkshire, J.P. Morgan, and Amazon to investigate what could be done about the current state of medical health care in the United States?
We learned a lot about the difficulty of changing around an industry that's 17% of GDP. We accomplished a lesser objective, which was probably more important to us even than either J.P. Morgan or Amazon, because we knew less about our own system than they did. They knew that there were more centralized operations. So we got some benefits in the sense that we looked at 60 or 70 different operations we had presently, and that's one case where a certain amount of centralization, at least in certain aspects of it, can save real money. I mean, we found inefficiencies, and like I say, we probably saved more than the other two partners because they knew their situation better. We found some dumb things we were doing, so we got our money's worth. But in terms of the big picture of changing something that so many people have a vested interest in doing, and there's one additional factor to it which is really interesting. There's an ingenious aspect to it. It goes back to a fellow named, which didn't have any direct connection, but Beardsley Rummel. And nobody's ever heard of Beardsley Rummel, but Beardsley Rummel in 1941 came up with the idea of the withholding tax. So people, instead of April 15th having to write a check and thinking how much they hated their politicians and hated the government and everything else, they actually looked at it as kind of a Christmas club, and there were overpayments involved, and they actually got a check when the final payment came due. So when you aren't writing the check yourself, you may know that the health benefit from your company is worth $10,000 a year to you, or $15,000. It may cost them that much, but it may cost the company that much, but you don't see it. So the company pays it, and most of the people in that waiting room sitting next to me, when they are not sitting there thinking about whether I can afford to do this, or what's this going to do. They're generally under some kind of a plan, not always, obviously, but they don't think that if the company wasn't paying them that, they could pay them to that in additional compensation. But of course, the weird system is the company gets a deduction if they pay it, but if you pay it yourself on a policy, I don't believe you get a deduction. So it's something that's most of the people are not seeing as a cost to them, and they like that pretty well.
No kidding.
Yeah, well, but that's true of the federal income tax. I mean, it was an act of genius from the standpoint of the government to go to a withholding system, and if you didn't, just think of how many people on April 15th would have to sit down and write a pretty good-sized check, and they'd be mad. They wouldn't like it, and they don't feel it now. So we were up. That's an obvious point, but you also, people like their doctor in general, and they don't like the fact that it's 17% of GDP. But one is just kind of a amorphous sort of thing, and the other is very, very real to them. And the most prestigious people in the community are on the hospital boards, and a lot of people that are fairly happy with the system. So we did not make inroads on that, and we are paying 17% of GDP for health care, and no major country is more than 11%. And in the pandemic, we've had a death rate or a death total as a percentage of population that's way higher than the rest of the world. Not every single country, but way higher. So we've laid out more money and gotten a poorer result in terms of this particular pandemic in terms of deaths per capita. Now, that may not turn out to be the...
Oh, Warren, even though you shot it and missed, you were at least shooting at an elephant. The cost of health care in Singapore is 20% of what it is in the United States, and their medical system works better. So you were shooting at a huge elephant. But as you found out, it's very hard to people to get very enthusiastic about losing part of their income.
Oh, yeah. No, I said we were fighting a tapeworm.
Yeah.
In the American economy, and the tapeworm won.
Yeah, the tapeworm,
Yeah.
That's good, wonderful phrase, the tapeworm. I'll have to copy that.
Well, it wasn't a phrase we were looking for.
Is there a point at which Berkshire becomes too large to manage? And should we have any concern over the lack of information for most of Berkshire's companies? Is there a time that could come when Berkshire's too large and complex?
Well, it's too large to do certain things, that's for sure. I mean, it's not, we can't spend our time looking for $100 million acquisitions. But we have a wonderful company in Fort Worth, and we had a marvelous man running it, and he died recently. But he ran it. He sold it to me 15 years ago, and he just basically ran it, and I couldn't find my way to the company. I mean, we've got this terrific company that makes recreational vehicles, Elkhart, based in Elkhart, Indiana, and we bought it 15 years ago. I've never been there, Maybe there's some guy in a closet just making up numbers to send to me every month. But I feel I understand the business pretty well, but I've never seen it. And the fellow that runs it likes running it, and he likes me keeping my nose out of it. And he'll let Greg in a little more than he'll let me because. but we've got a system that will work with wonderful businesses and wonderful managers, and it's up to us to find them. But it's also us to nurture them when we find them. And if you get somebody like Paul Andrews, who ran TTI and who built it from nothing, absolutely nothing, and nobody ever heard of him, and the earnings have octupled during the period that he ran it for us, and he was happy, employees were happy, he was a wonderful man, we were happy, and I would call him at the end of the year and I'd say, Paul, this place you're shooting the lights out and everything, and you should take a raise. And he said, or bonus or what. He'd say, well, we'll talk about that next year, Warren. I mean, he just loved the business. I love Berkshire, he loved the business, and I wasn't going to add anything by having him fill out a bunch of reports about how much he's using in the way of carbon or anything. It's ridiculous to think of a guy like Paul Andrews behaving in an antisocial manner or anything of the sort. And we'd love to have more of those. And obviously, as we get bigger, they get harder to buy. But we've got a number in the place, and I don't think we bought our last one over time, but I certainly don't see anything in the near future at all. But we're intensifying our interest a little bit in the ones we have by repurchasing shares. So our shareholders own more of those companies every year while assuming we're repurchasing shares, which is price sensitive. Charlie?
Yeah, I don't think we're getting too big to manage because we're different from practically every other big corporation in the United States in that we are so excessively decentralized. We have decentralized so much, and we have so much authority in the subsidiaries that we can keep doing it for a long, long time as long as it keeps working. And I would say so far that our decentralization has caused more benefits than defects. But nobody seems to copy us.
Well, but that's absolutely true. But I would say this: decentralization won't work unless you have the right kind of culture accompanying it.
Yeah, but we do.
Yeah, we do. But it's dependent on it.
And Greg will keep the culture.
If we had a culture of people who were trying to make a lot of money for themselves in the next 5 years at the top, it would not have worked.
No, of course not. And the culture is part of it. But assuming we keep the culture, it can go on quite a ways.
For a long, long time.
Long time. In fact, it may amaze everybody. And by the way,
Charlie
the
would
Roman
say to me-
Empire worked as long as it did because it was so decentralized.
Charlie says to me, "You won't know."
Yeah.
Ajit and Greg. Warren spends his days reading, and his literature of choice is annual reports. How do each of you spend your days? What do you read, and how do you review investment decisions?
In my job, I spend a lot of my time reading deals that brokers and people send us, reading what they're proposing, trying to analyze them, having a point of view, whether it is something that is of interest to us or not. I might add, I do not spend a lot of time reading annual reports because I'm not in the stock picking business per se. But in terms of keeping track of what's going on in the insurance business, that's what 90% of my reading is all about.
Generally in a day, what I'm going to focus on when I'm reading is really around our businesses, what industries they're in. I'm trying to understand what our competitors are doing, what's the fundamental risks around those businesses, how they're going to get disrupted. And then it always comes back to, are we allocating our capital properly in those businesses relative to the risks we're seeing both in our business and in the industry. So a lot of time spent on that. And as that knowledge is built, at sharing it back and forth with our management teams of those relevant subsidiaries and sort of fine-tuning it is really the approach.
Both of these fellows can absorb information to an extraordinary degree. I mean, they have, and for one thing, they're terribly interested in it. I mean, and it's theirs. So I'm amazed at both of them, the degree which they just sort of know everything, and but they enjoy it. I mean, they're not thinking about whether they'll get the next job that opens up at some huge place or anything like that. Nobody leaves us, basically the ones we want, but you really got to kind of be in love with your business, and that makes a huge difference. And that means that we've got to have the conditions that allow that love to flourish, and it wouldn't flourish with many organizations.
So what do you think about Robinhood and other trading apps or fintech companies enabling all ages and experience to participate in the stock market?
Well, I'm looking forward to reading the S1 on Robin. That's a big thing you file with the SEC when you are going to be offering securities, and it's become a very significant part of the casino aspect of the casino group that has joined into the stock market in the last year and a half. And I do want to see how they handle the source of income when they say they don't charge the customer anything. I mean, it would just be interesting to watch how they describe it. I mean, but they have attracted, maybe set out to attract, but they have attracted. I think I read where 12 or 13% of their casino participants were dealing in puts and calls. I looked up on Apple, the number of 7-day calls and 14-day calls outstanding, and I'm sure a lot of that is coming through Robinhood. That's a bunch of people writing. They're gambling on the price of Apple over the next 7 days or 14. There's nothing, there's nothing illegal about it. There's nothing immoral. But I don't think you'd build a society around people doing it. I mean, if a group of us landed on a desert island, we knew we'd never be rescued. And I was one of the group, and I said, "Well, I'll set up the exchange over here, and I'll trade our corn futures and everything around." I think the degree to which a very rich society can reward people who now know how to take advantage, essentially, of the gambling instincts of the not only American public, worldwide public. It's not the most admirable part of the accomplishment, but I think what America's accomplished is pretty admirable overall. And I think actually, American corporations have turned out to be a wonderful place for people to put their money and save. But they also make terrific gambling chips. And if you cater to those gambling chips, when people have money in their pocket for the first time, and you tell them they can make 30 or 40 or 50 trades a day, and you're not charging them any commission, but you're selling their order flow or whatever, I hope we don't have more of it, I'll put it that way. And I will be interested in reading the prospectus. Charlie?
Well, that is really waving the red flag at the bull. I think it's just god-awful that something like that would draw investment from civilized men and decent citizens. It's deeply wrong. We don't want to make our money selling things that are bad for people.
But we've got the states doing it with the lottery,
No, but that's bad too.
Yeah, I understand.
That's very
but I mean,
bad.
Once you
very
institute
bad.
first,
That's one of the things that's wrong with it. It's getting respectable to do these things. The states are just as bad as Robin Hood.
Well, in a sense, they're worse. I mean, they're really taxing.
I know
people based on
I know.
Yeah, they're taxing hope.
Not only that,
And they don't get much in the way of taxes from here, Charlie, when they do that.
The states in America replaced the mafia as the proprietor of the numbers game. That's what happened.
Yep.
They pushed the mafia aside and said, "That's our business, not yours." Doesn't make me proud of my government.
When I was a kid, my dad was in Congress. They had a numbers runner in the House office building, actually.
From raw material purchases by Berkshire subsidiaries, are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. I mean, it's not, if we get, well, take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up, and there hasn't yet been, because the wage stuff follows. I mean, if the UAW writes a 3-year contract, we got a 3-year contract. But if you're buying steel at General Motors or someplace, you're paying more every day. So it's an economy really. It's red hot. I mean, and we weren't expecting it. I mean, all our companies, when they thought when they were allowed to go back to work, at our various operations, we closed the furniture stores. I mentioned, they were closed for 6 weeks or so on average, and they didn't know what was going to happen when they open. And they can't stop people from buying things, and we can't deliver them. And they say, well, that's okay, because nobody else can deliver them either, and we'll wait for 3 months or something of the sort. But the backlog grows, and then we thought it would end when the $600 payments ended, and I think around August of last year. It just kept going, and it keeps going, and it keeps going, and it keeps going. And I get the figures every week. I call, or Bumpkin calls me, and we go over day by day what happened at 3 different stores in Chicago and Kansas City and Dallas, and it just won't stop. People have money in their pocket, and they pay the higher prices. And when carpet prices go up in a month or two, we announced a price increase for April. For our costs are going up. Supply chains all screwed up, for all kinds of people. But it's almost a buying frenzy, except certain areas you can't buy yet. You really can't buy international air travel, and so the money is being diverted from a piece of the economy into the rest, and everybody's got more cash in their pocket except for. Meanwhile, it's a terrible situation for a percentage of the people. This suit, I haven't worn a suit, for a year practically, and that means that the dry cleaner nurse just went out of business. I mean, and nobody's bringing in suits to get dry cleaned, and nobody's bringing in white shirts to get the place where my wife goes. The small business person, if you didn't have takeout and delivery services for restaurants, you got killed. On the other hand, if you've got takeout facilities, same sort of sales, Dairy Queen are up a whole lot, and they adapted. But it is not a price-sensitive economy right now in the least, and I don't know exactly how when it shows up in different price indices, but there's more inflation going on than quite a bit more inflation going on than people would have anticipated just 6 months ago or thereabouts.
Yeah, and there's one very intelligent man who thinks it's dangerous, and that's just the start.
When we look at steel prices, timber prices, any petroleum input, fundamentally there's pressure on those raw materials. I do think something you've touched on, Warren, and it goes really back to the raw materials. There's a scarcity of product right now of certain raw materials. It's impacting price and the ability to deliver the end product. But, that scarcity factor is also real out there right now as our businesses address that challenge. And it may be some of that's contributed or arisen from the storm we previously discussed in Texas. When you take down that many petrochemical plants in one state that the rest of the country is very dependent upon it, we're seeing it flow through both on price but overall in scarcity of product, which obviously go together. But there's challenges, that's for sure.
What do you think of quants? Jim Simon's Medallion Fund has done 39% net of fees for 3 decades, which proves that it works. Will you consider hiring a quant lieutenant in Berkshire to work alongside with Ted or Todd?
Well, I'll say no to the second part, and I'll let Charlie handle the first part.
Well, that's rather interesting. The leading quant fund did fabulously on the short-term trading. They found little algorithms that worked to make them, they had predictive value, and as long as they kept working, they just kept doing it, as long as the money kept coming in. When they got to using the same system, just to finding some little algorithm and trying to do it mechanically for long-term stock predictions, the record was not nearly as good. And in the short-term stuff, they found that if they tried to do it too much, they destroyed their own advantage. So there was a limit on the amount they could make.
But they were very, very smart.
Yes, they got very rich.
Very, very smart. And,
very smart and very rich, yes. And very high grade, by the way.
Yeah.
Jim Simons.
But we're not trying to make money trading stocks. I mean,
no.
The answer, we don't think we know how to do it. I mean, it isn't. If we knew how to make a lot more money trading stocks, we'd probably be trading stocks too. But we don't know how to do it, and we really don't trust anybody else to do it for us. That's simple.
Mr. Buffett has espoused for decades the philosophy of buy and hold or hold forever was too short of a time period. Is it a misperception on my part, or has his philosophy changed? It seems to be a much greater turnover in the equity portfolio lately.
I don't think there's that much turnover. I mean, but
but there's too much.
What?
There's way too much.
Yeah. Yeah.
It's still too much in the same amount.
Yeah. I'd agree with that. And the truth is, our businesses are equities. So we own 400 or 500 billion, and maybe more, in businesses. We don't turn them over at all. We don't resell businesses. We could probably, well, we won't even get into that, what we could do, but we don't do it. And we do relatively little. And as Charlie says, we'd do better if I'd done less.
Warren Buffett's 2013 letter in the middle of page 21 made a prediction that in the next decade you'll see lots of really bad news about pensions. Given recent events like COVID-19 and that 2023 is 2 years away, would Mr. Buffett like to comment or revise his 2013 prediction?
In a very limited, a terrible way. COVID improves the pension position because the more, it's, you have less pensioners. But the pension situation is terrible in a great many states. It's not so bad at the corporate level, and there's some multi-employer plans obviously that have got problems. But basically, it's a terrible problem for the states, and of course some states, and states are going to go to Washington now and say, we all want to get a lot of money because we had these terrible things happen to us during the pandemic, which they did, but some of those states have enormous pension deficits, and they'll come again if they get a check once. It may turn out to be a federal obligation de facto or something than a state situation. It has not gotten better. It has not gotten better at all, and obviously, and to a certain extent, the pension managers get more and more desperate as interest rates go down. So they'll listen to almost anybody that promises them. They've always had that tendency anyway, but they'll listen to people that promise them that they're going to, one way or another, solve their problem for them, and that isn't going to work. So it's a big, big, big problem. And of course, the real problem is, let's just take a hypothetical state that has a huge pension deficit and maybe even has a cost of living factor in it, which is going to really be a killer. And you can move if you're an individual. Charlie won't move to save that $500 million. He was not going to move to Nevada or someplace. But you can move if you're an individual to some degree, particularly if you're rich and old and retired. And you can actually take away an asset from that kind of environment and give it to another state that doesn't really need it as much. So you'll get adverse selection over time. But if you're a company and you put a plant there, you can't move the plant in 5 or 10 or 20 years. So as the taxable base of individuals falls down, simply because people select out of being a part of the population, you can't select out very well as a corporation. So you have to be very careful and think a long time before you go into some state with a huge pension deficit and a declining population, because you're going to be the last man left, and the pensions won't go away. And I don't think, anybody with a short-term outlook doesn't worry about that. Just get me to pass the next election, and I'm all right on that one. But we don't want to be. We're not going to stay a plant that's going to be around for 50 years in some place where the population gets halved and the richer part gets cut dramatically, even more dramatically, and we still got a valuable plant there, and we got to keep operating, and we're going to, one way or another, it's not going to be a good place to be.
That's a good answer, Warren. It reminds me of my old Harvard law professor who used to say, "Let me know what your problem is, and I'll try and make it more difficult for you."
What's the biggest lesson both of you learned during the last year?
Well, my biggest lesson has been to listen more to Charlie. He's been right on some things that I've been wrong on.
Well, I don't know. If you're not a little confused by what's going on, you don't understand it. It's just, we're in sort of uncharted territory.
We enjoy, in a crazy way, actually seeing what happens. I mean, and this has made us halfway through the movie much more interested in watching even more of this. This is an unusual movie, but our basic principles of, we start with the fact we don't want to disappoint the people who left their money with us, and things flow out of that. And we may disappoint people that don't make quite as much money as they want, but we don't. And we've seen some strange things happen in the world in the last year and 15 months, and we've always recognized the fact that stranger things are going to happen in the future, and I would say if anything, it's reinforced, our desire, to figure out everything possible we can do to make sure that Berkshire is 50 or 100 years from now, every bit the organization and then some that it is now. Charlie.
Well, of course, that's the idea. I think it's pretty likely to work.
Well, we wouldn't have spent 55 years at it unless we did.
Yeah.
Yeah. I would just like to add one final comment that I really hope, and I think the odds are very, very good that we get to hold this next year in Omaha, and I hope that we get a record turnout of Berkshire shareholders, and we really look forward to meeting you in Omaha. I guess it'll be next April 30th, but we'll be sure of that date a little later. So thank you for watching, and we will see you next year and hopefully in Omaha. Meeting's adjourned.